Okay, good morning to everyone. I hope you're all fine and ready to take a course of today. Welcome you all to yet another session of Advanced Taxation. Today is our lecture number 5. Effectively, as the first lecture was on introduction, started the course um, as from the lecture number 2. And we have had 4 sessions already. In those 4 sessions, you people have been with me. And we have finished the capital gains taxes, 2 chapters. One was an introduction one. The second one was further aspects. A lot of stuff itself in those 4 sessions we have finished. It requires to have your regular look back to those topics we've done, because easily you can forget when you do not consistently look back in and revise. Today we are taking a start of another topic, inheritance tax. A topic that will take more or less the same amount of time, maybe a little less than we have spent time on capital gains tax. But the course of today will totally be on the knowledge which you people have learned at level 2 will be a revision of that. But this revision of today will take us towards to the complex aspects of inheritance tax in the next course. So it is equally as important as to learn the complex aspects, because complex aspects cannot be learned, cannot you get entry into the complex aspects without being done with the basics first. And you people have experienced it while learning the capital gains taxes. So I don't have to say that again. It's obvious. The knowledge of tax you have to have, which combines the effects of the basic knowledge and advanced together as a one pack. This is the first chapter on inheritance tax, being titled as Introduction. And then this is going to be another one we will do next week, further aspects, which we can only get into when you're done with this one first. So without wasting any further time, let's get into the start of inheritance tax. So as the name suggests, inheritance tax, on a basic, it is a tax on the death of individual, majorly, But to define it very formally, the way it has been defined into our lecture notes, inheritance tax is charged arises on the transfer of value of the chargeable asset by a chargeable person. So inheritance tax arises on the transfer of value of the chargeable assets by a chargeable person. And this is how the way when I started off with capital gains tax previously, I started off by defining it first in a formal manner. Arises on the transfer of value of the chargeable asset by a chargeable person. The transfer of value in simple word means the gift of an asset. Gift of an asset. As the name suggests, transfer of value, because the gift which has been transferred has a value attached to it. So it's transfer of value. You go a little slowly onto this transfer of value, because whatever has been transferred must have been having a value. So it's a transfer of value. It simply means a gift of asset. All the assets in the topic of inheritance tax are chargeable. Not like capital gains taxes we have done previously, where there were exemptions, disposing a motor car, disposing an investments into national savings certificates, individual savings accounts. People can remember there was a list of exempt disposals. Whereas in the topic of inheritance tax, almost everything is chargeable. Unless or until the asset has been transferred to those parties like spouses, like charities. We will see it with the time to come. But the type of asset is not exempt. We will not say that this motor car is exempt, this investment is exempt. Everything is chargeable. I'm giving you an example. The motor car, disposing a motor car was an exempt disposal in the topic of capital gains tax. But now in the topic of inheritance tax, if the motor car is gifted, it is chargeable. Yes. If the motor car has been gifted to wife, that will make the motor car to be an exempt asset, because the asset is not exempt to whom it has been gifted to, making it exempt. Later on, we will come to see that to whom the assets are transferred to other than spouses, those are considered to be as exempt transfers. So assets are not exempt. To whom the assets are transferred to sometimes will make us exempt to transfer. The top of that list is a transfer to spouses. I'm using the word transfer. I'm using the word gift over here because this topic is all about making a gift of asset, not disposing an asset. Disposing an asset was the topic of capital gains tax. This topic is all about gifting. What makes the person to say a chargeable one? UK domicile. Then we will also look into if the person is non-UK domicile, Will the person be paying inheritance tax? Yes, but we will look into it. But on the first, this is an assumption we will have to take that the person is a UK domicile and will be a chargeable person to pay inheritance tax on worldwide transfers. The transfers, those are being made within and outside the UK, worldwide. So that is a very formal definition of inheritance. A gift of asset by a chargeable person. Gift of an asset, all assets are chargeable. Quickly, if you look onto the first page of this chapter, it writes the same. Transfer of value of chargeable property by a chargeable person. A person who is UK domicile is said to be as a UK person and pay taxes on worldwide assets. Gift of almost every asset is chargeable. There are no such exempt assets for the purpose of inheritance tax. Transfer of value. Transfer value is a gift of capital asset that brings the reduction in the value of donor's estate. Simply means a gift. One who makes the transfer of asset is called as donor. You know that to whom an asset has been transferred is called as donee. You people are aware of these terms, donor and donee, from the topic of capital gains tax previously. Reduction in the value of donor's estate. It's a common sense. If I have 10 assets and I decide to gift one asset out of it to someone after gifting, will I be having more assets or less assets? Less assets. 10 minus 1 equals to 9. So before gifting, I had 10 assets. After gifting, I have 9. So reduction in the value of estate as a result of gift. It's pretty obvious. It's a common sense you all can. The transfer of value is simply means a gift of asset that brings the reduction in the value of donor's estate. Estate means all of his wealth on the day of death. That includes almost everything that he or she owns: bank balances, insurance policies, businesses, private motor cars, private houses, any sorts of personal receivables, trade receivables, or any obligations if he or she has, we must have to offset in terms of taxes payable, trade payables, personal liabilities. Like in accounting courses, in order to find the value of a business, what do? We try to find the value of net assets. So value of net assets equals to the value of company. So net assets, how do you get that? Total asset less total liabilities. That's what we are trying to do for that individual, that whatever he or she owns minus whatever he or she owes to someone. And then the net answer that we get is the net worth of his estate on the day of death. So we obviously will come to work this very formally. If I have to give you a basic idea of estate is the whole of his wealth on the day of his death. That basically is worked by making a list of all the assets minus the list of all the liabilities and equals to the value of estate. So with the gift, definitely there'll be a reduction that you all can sense. Everything is chargeable. Nothing in the topic of inheritance tax is exempt. Who is a chargeable person? A person who is a domiciled in UK. Worldwide, yes, in case the person is non-UK domiciled, will still pay UK inheritance tax, but on UK assets only. This is the formula one has to use in find the value of transfer. The title of this formula is loss to donor principal. And it's very fair to work the value of the transfer this way. It's very logically understandable as we try to compare the picture that is before and after. Picture before gifting and picture after gifting. So the whole change that will be witnessed is a value of transfer. Before after picture, sometimes even on social media, a picture that is before and picture that is after, and you are asked to find the difference into it. Even when you were young, when to whatever you are right now at, you try to compare your picture of when you were a child and when now you've grown up. You easily can find the difference in the picture that is before, the picture that is after. That is what, in this case, you have to do. A very logical way of finding the transfer. But if I say that, okay, if I have $100 in my pocket, $100 or any currency, rupees, and I take $30 out of it to give to someone, now I will see what do I have it into my pocket after $70. So a picture before 100, a picture after 70. So what has actually been gifted? 30, the difference. This is the loss the donor has suffered in gifting because he had 100 with him before. Now he only has 70 after. So what he has lost while gifting, $30 is the value of transfer. See how logical is that to find the value this way. Compare a picture that is before with the after. So the whole change that has been found, or in fact, the reduction that has been found is equal to the value of transfer. It's also called as diminution in value concept. The word diminution means reduction. Simple word. It means reduction in value. Sherry owns this much shares, 70% of the whole she had. She gifted this much, and 30% of the whole in the company. She has been owning 70%, she has gifted 30. That means after she would be owning 40%. This is the value we will be using in the picture that is before, 51 to 75%, 70%. And in a picture after, this is the value we'll be using because 40% will be in between 26 to 40. And easily we can find the value of the transfer by this way. Too basic to handle these things. But again, if I have to say this, that you don't carry this knowledge when you come into advanced taxation course, I will not be wrong. Am I right? Do you carry all of that knowledge when you come into an advanced taxation course? You do not. Sorry. So these things are basic, but the time has to be spent on. And you people have seen the way the whole topic of capital gains tax was organized. How the way the basics with the complications were embedded together. That sometimes you do not even realize, is this the topic of taxation course or is this the topic of advanced taxation course? If I do not come to specifically mention that, yeah, this area is from, I kept on mentioning that this part of this topic is from advanced taxation. This part of this topic is from advanced taxation. If I have not done it, you may have not realized even. We rather have to take this as the whole knowledge of tax, which is a blend of basics and complex aspects. You need to just be aware of this entire world of tax. And that's the reason why it's as important to spend time on the basics as later you invest more time onto the advanced aspects. Undoable advanced aspects if you're not done with this. You've experienced that in the capital gains taxes before. So 70% hold the value of share was £27. After she would be owning 4,000 shares, the value of each share at 40% of interest is £18. This is 189,000. This is 72,000. And this is the value that she has lost. So she had been having 180,000 in her pocket before making a transfer. And she is only left up with this much in the pocket after making a transfer. So what she has transferred is this. That is the difference, or that is in fact the loss in value. This is the loss she has suffered in gifting, as this is the amount she had been having it in her bank account before, and she would have this much now in the bank account. So what she has lost is this, equals to the value. So how logical is that? And enough of a time with a lot of patience I've spent on. Let's move forward. Occasions of charge. Very important. The name inheritance tax, the moment it comes front, we start thinking of as if someone has died. And upon the death, the inheritance tax will become applicable. This is the first thing comes to our mind. But no, it is applicable in life also. The person may have not even died yet, still ends up paying inheritance tax when he or she is alive. This is what we have to understand why. Should be on death, as the title of this topic suggests, inheritance tax. Inheritance is the gift of all of his wealth to the family around upon death. That thing is called as inheritance. Upon the death of someone, the assets are gifted to beneficiaries, usually to spouses, daughter, children. So that thing is called as inheritance. So the first thing that comes to mind when we say inheritance is the word death. Someone has died, and now on the death, by a will, the assets will be gifted to the family people around. This is where we will have to understand it's not the consequence on death, it can be applicable in life also. See, everyone has to die one day. So we can plan a tax by this way. How can we avoid not paying an inheritance tax on death? If I know that I have to die one day, I can start gifting all of the assets in my life today. so that tomorrow if I die, I do not have any asset on my name being owned. So on the death, when I will not have any asset on my name, the inheritance tax can simply be avoided because all of those assets being transferred into my life, to my family around. So anyone can just avoid an inheritance tax by this way of gifting the assets in the life before the death. Understanding that point or not? Today, if I own a car, today, if I own a house, today, if I own this much of cash balance, today, if I own an insurance policy, today, if I own a business, I can start gifting all of that today to people around. So tomorrow, if I die, I do not have anything on my name. Inheritance tax can simply be avoided tomorrow if I can die. So to prevent this to happen, inheritance tax will even become applicable today if I make a transfer of an asset to someone, so that the tax cannot be avoided. I cannot get an escape from paying the tax. Got the sense right? This is what is written back into this last point, last paragraph onto this page. See, most of the inheritance tax is collected on death. So it would be very easy to simply giving away assets immediately before death to avoid paying the tax at death. For this thing to understand, someone does not have to be an ACCA member or a tax consultant. Even a common man can understand this planning, gifting an asset today in the life, so that on the death, tomorrow, if he or she dies, the tax can simply be avoided. So that is the reason why there are tax implications both on the lifetime and death transfers. Whatever I will be gifting to someone in life will become taxable itself in the life, firstly. And then whatever the assets will I be left up with on my name on death via will be taxed also. So cannot be avoided. And this is from where this topic is taking two dimensions, two main occasions of the charge: the gifts being made in the life of person, the gifts being made upon the death. Obviously, the gift on the death are by the way of will, which is a normal thing that you are aware of. By the way of will, the assets are allocated to the family people around on death. Life comes before death. So we will have to spend time onto lifetime transfers first before dealing with the death transfer. Understanding? You have to follow a logical order. You cannot change the whole system of nature. The life comes before death. So we must have to deal with the lifetime transfers before, at later stage, we will also be able to deal with the death transfers. And this will take time. It's not a topic of 50, 30, 60 minutes. It will probably take the next 2 hours before we will be able to take ourselves toward death transfers. So lifetime transfers. Or if I have to once again formally write it, transfers, the word is more commonly used, but it simply means gift. The word transfer is used in the context of gifting an asset, not the sale of an asset. This topic is not about selling. This topic is all about transferring an asset, gifting an asset. In life, maybe, or upon death. So two transfers. The one is called as lifetime transfers. Second one is called as death transfer. As the name suggests, lifetime transfers are those gifts made in a life of a person is called as life. If the same gifts made upon the death of individual, that will be called death transfer. And these gifts upon the death are via will. It's pretty much obvious. Even if I don't write, you can understand why is it like this. Because that day the person is no longer alive. The will have everything. By the way, the assets will be passed on to the beneficiaries, the spouses, children, the grandchildren, or to some other persons. But this one is being made by himself when he or she is alive. And this is what we will be concentrating it on first by spending the next safely 2 hours, not less than 2 hours, lifetime. So let's get on with lifetime transfers. Now, within this, we will expect to see two types of transfers. There are two types of lifetime transfers. One is called as potentially exempt transfer. The second one is called as chargeable lifetime transfer. This is potentially exempt transfer. And this is CLT. So what makes the transfer to say PET and what makes the transfer to say CLT? What makes the transfer to say PET? What makes the transfer to say CLT? What makes the transfer to say PET and what makes the transfer to say CLT? Individual to individual transfer. The transfer has been made by one of an individual to another one. It is potentially exempt transfer. But if the same transfer being made by individual to a trust, that one is called as CLT. So I'm contrasting it. On this page itself, you'll be able to see a nice contrast of two. Individual to individual is PET. Individual to CLT is to trust is CLT. Okay, let's go to list down some rules. Which one is taxable in life? Which one is exempt? So which one is taxable in life? Which one is taxable in life? This one is exempt in life. This one is exempt in life. Well, this one is chargeable and easy to remember because the titles of that suggest potentially exempt transfer. Here, chargeable life transfer. Potentially exempt transfer. Chargeable lifetime transfer. Potentially exempt transfer is exempt. As the name suggests, potentially exempt transfer. And as the name suggests, chargeable lifetime. So that is chargeable. Upon death,
we will have to look into the further 2 points. They say that if the death is within 7 years, if the death is not within 7 years, not within 7 years. So if death is within 7 years, if the death is not within 7 years, if the death is within 7 years, then it is chargeable. And if the death is not within 7 years, it is exempt. And the rules for the death are same for both. So I'll have to just copy and paste the same figure over here, the same thing over here. So right now we are not explaining anything. I'm not explaining anything. I'm just trying to write down some basic rules. Later, with the time to come, we will be using. The death rules are same. They say that if the donor dies within 7 years of making the transfer, the transfers are taxable on death. And if the donor has survived for 7 years, exempt on that. PET, CLT, may be whatever. But in the life, PET is exempt, CLT is chargeable. What is PET? A transfer being made by individual to another individual. That another individual can be any party, brother, sister, daughter, father, mother, even any unknown party, uncle, cousin, first, third, fourth, fifth cousin, or even a friend. Does not need to be a relative. I haven't said it. Any individual. But if the same transfer being made to a trust, trustees of the trust, that is CLT. And all of that thing has been written over here. But after spending time onto it, 5, 10, say 10 minutes, this becomes so easy to read. And even if you do not read, you're not missing anything out from. Still, you can look. Transfer being made by individual to individual, and that is to a trust. Exempt in life, chargeable in life, immediately. That's the first thing. And then they're talking about remain exempt if the donor survives for 7 years. But if donor dies within 7 years, becomes chargeable. So that is the summary of summary. And these notes are not as detailed as even the study text are. Easy to read. And especially after my board explanation, it becomes so comfortably you can read that out. And like I said, even if you're not reading, you're not missing anything out because all what needs to be learned, I already have explained. But this thing I always have done. I always have tried to take you back to the lecture notes to show which part of the lecture notes are writing all of that stuff in which manner that you always have seen. We see every part of the lecture notes that we cover it. You see that it's highlighted, it's underlined, it's annotated. Has been the case in the past also with capital gains taxes. So we are done with. Now we are heading towards the exemptions. This topic will be taking exemptions. Like we've done few exemptions previously, annual exemptions. We have done some exemptions. This topic has got its own exemptions. Assets are not exempt, but these exemptions are of other kinds. In different situations, we will have to make the use of these exemptions. The first one we are starting off with is called as small gift. So what makes a gift to be a small? Do we have to look into? This one is applicable to, first of all, a potentially exempt trust. This is not applicable to CLTs. Small gift exemption is not applicable to CLTs. It's applicable to pets only. What makes the gift to say a small? The value of it. Less than equals to £250. More or less the same price you pay for your exam fees is nowadays. Small value. No, as far as exam fees is concerned, it looks big to you, but as far as gifting someone, the context of this topic is a small value. Because inheritance tax, a topic is about gifting assets, properties, motor cars, investments. So in contrast to that, this 250 pound looks to me like a very small value gift. This 250 pound may be a bigger value to you as an individual. But in the context of topic that we are discussing today, we're talking about gifting the properties over here, businesses over here, motor cars over here. So they have a high value, thousands of pounds. So in contrast to that, 250 pound value gift is considered to be definitely a small gift. Cannot be taxing it. It's too small to tax. But respecting that 250 pound per gift, no, it's per person and per tax year. And this I can come to explain to all of you how to apply. The first possibility, Mr. A making a transfer of an asset to B, and the value of that gift was 210 pound. See, it's pet because I'm involving individuals in, not trust in it. CLTs are not going to take that. Pets will take the small gift exemption. So I have found this to be as a small one. So I will be calling it as exempt. And the reason of that is as it is small. Next example. Let's try to make it big by changing the value of it. Let's go to change the value of that to 270 pound. Now that surely is more than to that 250 pound park. So I will have to charge it. And when I will say it will be chargeable, and importantly, the whole is chargeable. Not you will try to charge only the excess of 20 pound over to 250, whole 270 will be chargeable then. I still have to explain this to you how to charge. We are right now discussing only over here. Will it be charged? Will it not be charged? So don't question me how to charge. What is the rate of tax? What are the band limits? We will do it all. Right now, the discussion is to just understand the first, which one is chargeable, which one is not chargeable. Whole will be chargeable. 270 will totally be chargeable, not just the excess of 20 pound over to 250. Third possibility. In third possibility, let's try to bring another possibility into it where I can now incorporate, instead of one gift, I can incorporate two gifts. Gift one and gift number two. The value of the first gift is 210 pound. The value of the second gift is 180 pound. Now, this is where this thing will come to our way, per person per tax year. So if in one tax year, the gift has been made to the same donee, two of them, three of them, five of them, but to a same person. So do we have to apply this 250 pound to each of the gift, or rather the total? If I look into each, it's small gift. It's small gift. But we will rather have to see what effectively this person has received. 180 plus 210 looks to me 390 pound. Both will be chargeable. Both are chargeable. Because we do not have to see per gift, we rather have to see per recipient. Whatever he or she gets in that one tax year in total, 390 pound, both will become chargeable. So if you do not respect this, you will end up realizing that this is less than 250 pound. This is less than 250 pounds. So let me make both of those gifts exempt. Not going to be the case. So just remembering 250 pound is not enough. See the different possibilities and try to learn it and remember it. If that was the case, I would have written it 250 pound per gift. But rather I am writing per person. So person is only one. We rather have to see collectively whatever he or she gets in that one tax year. to be checked with £250, which definitely is £390. Both are chargeable. Yeah, if this was being given to Mr. C, I would have exempt the both. I would have exempt the both. Because then I would come down to check Mr. B only gets £210. Mr. C only gets £180. So both of those gifts would have been exempt then. To a same person, that you need to respect. And in one tax year, you cannot now combine all the tax years gift together. Each tax year. But that is all what has been written over here for small gift. Outright gifts to individuals, £250 or less per recipient in one tax year exempt. Only applies to potentially exempt transfers. See, this is where they are suggesting if the gift value is more than to £250, whole amount is chargeable. I have explained every bit of that already to you. If individual makes a gift of £250.45 to a person, followed by another gift of £125 to the same person, neither of the gift will be exempt. Because we have to come down to check the total value of the gift that same person has received in that one tax year. That's definitely more than £250. So this text starts looking friendlier when you have got this explanation to back up with. Moving on to the next, marriage exemption. As the name suggests, this exemption is applicable to only a case when the gift has been made upon the wedding, upon the marriage of an individual. So it's topic specific, means you cannot make the use of this exemption unless or until in the question the wedding is taking place. Got my point? Mr. A gifting off to Mr. XX. And this time it says, it's not just a gift, it's the wedding gift. And the value of this gift is £9,000. It's once again potentially exempt transfer because individual will be involved in the case of wedding. Trustees and trust will not be involved. Does not make any sense. What is important in the marriage exemption is to look into the relationship of donor to donee. Let me add it. So Mr. A has been a father and X has to be the son to that father. If it is more than to £5,000, it is chargeable, taxable. This 5,000 is not an example, it is an exemption limit. One has to remember when the gift being made by the parent to the children. For the grandparent, the threshold is different. I can reveal it. Party to a marriage, bride to groom, groom to bride, different. Anyone else, different. So this 5,000 is the exemption limit that's applicable to parent relationship, which is right now the case. So is it taxable? Yes, because it's more than to 5,000. How will it be taxable? This how the way will it be taxable? 9,000 minus 5,000. This will be chargeable. Only excess will become chargeable. Now, this is different from the case of small gift, because in the small gift, I was like, once it is more than to that £250, whole is chargeable. Here I'm saying, no, only the excess will be chargeable. So this is something that you have to respect. You cannot be casual on that, especially being a student of advanced taxation. These things will have to be so much always on point. Excess will be taxable. Not this time I say the whole 9,000 will be. Now I can finally reveal the different limits depending it upon the relationship that is involved, and that you have to remember it by yourself. Check this out. For a parent, it's 5,000, but for a grandparent, it's the half of it. Party to a marriage, 25, the same, and anyone else 1,000. That needs to be remembered. Never will be given to you in the tax tables on the day of exam. You have to remember this: 5,000 by a parent, grandparents, and party to a marriage, they share the same 2,500. And you can easily remember that by just remembering it, the half of that, the half of 5,000. And anyone else, 1,000. It's pretty obvious that you only can apply this exemption thing when the marriage is actually taking place. End of the story. So small explanations one has to have a knowledge of, and you cannot just spend an hour of explanation onto it. You finish it up by spending 5 minutes onto that, you move forward. You move forward. And that knowledge, to have it, is equally as important as to have a knowledge of complex aspects at the later stage. Third one on the way is normal expenditure out of income. Normal expenditure out of income, or normal expenditure or expense out of income. What does that mean? Normal expenditure out of income. Out of income. What makes an expenditure to say normal? There are a few things to look in. Let's start with those. Number one, they say that the gift that you have made must be habitual. It must be having a regular pattern of giving. And lastly, it does not affect the donor's standard of living. Does not affect the donor's standard of living. Regular pattern of giving and habitual. See, we're talking about those gifts. Those are normal to our lives. You probably have guessed what I'm talking about. Birthday presents, Christmas gifts, Diwali gifts, Eid gifts, Easter gifts, Chinese New Year gifts. There's one thing common in all of those gifts: regular pattern. They're not one-off, they're not exceptions, and they are normal to our lives, aren't they? Affecting the standard of living. If you're gifting the snacks to someone on these festivals, will it affect the standard of your living? Will you become poor after gifting? No. They are not of high value. They're habitual. And they must have been a regular pattern of giving, recurring in kind. Every year they are given. Those sort of gifts will fall under there. You can't expect to pay inheritance tax on those gifts. They're too normal to our lives. Have you guessed what I have said? That is normal expenditure out of income. So it does not have any limit or threshold, but the nature of the gift itself will suggest it's normal to our life, therefore will not be applicable to inheritance tax. So lifetime transfer can be exempt if it can be shown that the gift that it has been made is a part of the personal's normal expenditure, does not affect the standard of living. Normal means the gift must be habitual and there must be a regular pattern of giving. Okay with that? Annual expenditure, annual exemption, number 4. Now we have seen annual exemption before, haven't we? We've seen annual exemption for capital gains taxes before, so this topic also have to, and the idea is same, just the limit of that is different, idea is same. It exempts the part of the value of transfer, and if the gains, they go down, you have saved the capital gains taxes in the past. Now, if the value of the transfer will go down, you will end up saving inheritance tax. So the idea of deducting the annual exemption is just the same as before. So I do not need to comment much on, except I can come down to write the limit of it. The limit of that is £3,000 for tax year 20 to 23 that we are in. £3,000. If suppose the transfer of value is 10,000, then I will be able to exempt 3,000 out of it. The chargeable amount will turn out to be 7,000. So as before, for taxable gains, 12300. Now for this one, 7,000. This much will be exempt. First, £3,000 will be exempt. Access will become taxable, like previously, 12300. You people have always used while computing the capital gains. Okay. Any part of the exemption, if not used, will be carried forward. Let me write. Unused annual exemption can be carried forward to one next tax year only. Any part of the annual exemption, if not used, we will be having a chance of carrying it forward. Only one next tax year we can, not infinite. That thing is only applicable to inheritance tax. Don't start applying that to in capital gains taxes. I never have said this, where in the capital gains taxes, any unused in exemption was always the waste. We never have carried forward the annual exemption that was wasted in capital gains tax topic. Yeah, losses, capital current year brought forward losses, we had been carrying it forward. Annual exemption we never have. But for inheritance tax, this is allowed. And then you must have to understand the whole etiquettes, that you can't just carry it forward to any next tax year. One next only. It's not countless number of years, it's only one next tax year. Still not used, then it will be a waste. You can't take that down to a second next tax year, third next, you can't. Just one next tax year carry forward is allowed. So that discussion is only applicable to inheritance tax. After that, do not start applying the same logic to capital gains taxes. Try to understand the differences of one topic to next and respect it. Don't just mix them off. So any part of the annual exemption, if not used, or if the whole amount has not been used, that will be carried forward to one next tax year. So in one next tax year, suppose it's being carried forward. So in one next tax year, now we will have that tax year's annual exemption. And this year's unused effect, and if I assume that is 3,000, then the next tax year will have total of 6,000 annual exemption. So it all depends. If in this tax year, whole 3,000 has not been used, fully will be carried forward. So in any one given tax year, the maximum annual exemption that one can possibly use is 6,000, not more than this. It can be less than 6,000, but it can never exceed the mark of 6,000, because 3,000 of that tax year and maximum 3,000 from the last year being carried forward, maximum in one tax year that can be used is 6,000. And the sequence of that needs to be respected. First, that tax year's annual exemption will be deducted first. And then we will take the unused carry forward effect next to. You will come to see all of that in one question I'm about to solve over here. But that's annual exemption for all of you. Annual exemption is an exemption that's been available against both the lifetime transfers, exempts the first £3,000. Any unused portion will be allowed to carry it forward to one next tax year. It then can be relieved from the next year after leaving that year's annual exemption. This is what I've told you. The sequence of that is to deduct that tax year's annual exemption first, followed by the unused carried forward exemption from the last. So maximum amount that one can use in that one tax year will not exceed the mark of 6,000. Maximum will be 6,000 because 1 year carry forward is allowed. Okay, so what if in one tax year we have variety of gifts? So we will be having 3,000 applicable to each transfer. No, it's annually once available. Like previously in capital gains tax topic, you deduct the annual exemption once out of total gains, not separately. Each asset being disposed gets his own annual exemption. So the same logic is applied. If I have made 5 gifts, I will be able to get only one 3,000 that will be used against those 5 transfers. So will I be allocating the 3,000 pound to 5 of those gifts equally, or will I be just using my it will be applied in a chronological. So it's not going to be my choice. It will be applied in a chronological manner. What does that mean? Date wise, whichever the gift that has been made first in that tax year will come to use that annual exemption. Chronological order means strictly you have to follow it. You cannot just use your own choice in deciding that this asset I should match it up with annual exemption, this asset I should not. I rather have to respect the date, the chronological order. If there are 3 gifts, I will have to see which gift has been made first into that tax year. That will take the annual exemption on the first. Chances are there that the first asset has fully exhausted the annual exemption, then the next 2 assets will not take any. Or if any part has not been used, the remaining part can be given to the next. So case is very simple. You have been given a strict order and you have to follow it. And the order is go and apply in a chronological order. So that is it. And you will get to see this in a very formal way when I will go to work this application to in about next 1 minute. So that is annual exemption for all of you. Number 5th and the last one. It says inter-spouse exemption. And this is what I was telling you in the start of the topic, that inter-spouse transfers exempt. Exempt regardless of the type of asset, value of asset, and the timing. Timing means the life or death whenever. Exempt. Exempt. So you really do not look into the value that has been transferred. Maybe it's $1 million asset, £1,000,000. You do not look into it. May it be a motor car, may it be a business, may it be a factory building, may it be a private house, any type of asset, any value of it, any time, life or maybe death, completely exempt. They have to be the spouses of married couple at least. Husband to wife to husband, exempt. So this is not the exemption where we will have to come and look into the value of transfer, that there is a certain threshold. No, any value, $1 million may be £1 value asset, £5 value asset, £50 value asset, £1 million value asset, any value, any type, may be a motor car, business, private house, factory building, this asset, that asset. And regardless of whatever the time it was being transferred, may in the life of person, may upon the death, totally exempt. Transfers in between the spouses are exempt, regardless of the value, whether they are being made in the life of person upon death, and the type of. So if they make a transfer of private house, husband makes the transfer of private house to his wife, it will be an exempt transfer. House is not exempt. The relationship is making us to call it exempt transfer. If the house was being transferred by brother to sister, it would have never been an exempt transfer. Understanding it. House is not exempt just because it's been transferred by husband to wife or wife to husband, making me to say that it is an exempt transfer. If the same house was being transferred from father to son, father to daughter, mother to son, brother to sister, it would have never been an exempt transfer. See, we are done with. Anything that you see this page has written on and I have not looked upon, here and there, scanning it out, scrolling it down, finishing it, moving it forward. But that's how the way this topic has even started, and we are going it nicely on. Enough of our time, I'm spending it onto each, making it show that you all get back to the flow that you were in while you were learning these things at the level 2. And this obviously will give you the enough of the knowledge to start getting into the complex aspects, advanced aspects into our next course. This question requires us to work the chargeable amount of the gifts after making the use of all of those available exemptions. Chargeable amounts. The chargeable amount is the amount that's after deducting any available exemptions. Small gift, marriage, normal expenditure, in-will exemption, inter-spouse exemption. The first 4 that we have talked about, the first 4 of them, this one, this one, this one, and this one. These 4 exemptions are applicable to lifetime transfers only. You may have not noticed. Now you should come to exemptions available only for lifetime transfer. Small gift, marriage, normal expenditure, annual exemption. These 4 are not applicable to death transfers. These 4 are only applicable to lifetime transfers. But the last one that we have talked about, 5th one, inter-spouse exemption, is applicable to both the lifetime and the death transfers. This is also something you have to remember. It's the 5th one on the way. 5th. First 4 are only applicable to lifetime transfers. The 5th one is applicable to both the transfers. And that you also can cross-refer it from this last point. That inter-spouse exemption is applicable, may the transfer being made in the life of person upon the death. This was one of the conditions I was writing it earlier on, so that you also can remember it this way. Timing of transfer may be in the life of person, may upon the death. Itself confirms what I have just been able to formally highlight. Application 2. A very easy little application, but the healthy one, which will enable all of us to at least gain a command over to how to make the use of these available exemptions. A manual made the following lifetime gifts. Lifetime gifts. Because we are focusing on lifetime transfers at the moment right now, not the death transfers. 800 to a son on 30th of September 2016. So let me label it. The first one is PET. The second one is CLT, just because of this reason. Third one is CLT. Fourth one is CLT. Fifth one is PET. And that too needs to be noticed, wedding present. Now, this is going to give us that marriage exemption. Unless or until the question does not say it's a wedding present, you will not be thinking of making the use of marriage exemption into it. So annual exemption is applicable to every scenario because by default, annual exemption is applied. Wedding exemption is only applicable when the wedding, the word has been used somewhere else, like in this. While small gift requires us to look into the value of transfer. So you have to keep an eye on the value of that also. So to make it small. And I don't see any of the gift is small because all of the values, they are going up to that mark of £250. This is the way you have to check this by yourself. And I don't even see now in this, there is some Christmas present, birthday present, so I can bring this thing into my talk. So that's not even applicable, normal expenditure out of income. Yes, annual exemption by default is applicable to every gift. And so is the case. No, it's the only one annual exemption which is by default applicable to every transfer. This is not applicable right now. This is not applicable right now because I don't see any of the value less than to that £250 mark. Yes, this marriage exemption will be applied only to this one transfer. While I don't see any interspouse transfers as of yet because son trust is involved. And finally, the spouse is also involved. So this is going to be an interspouse transfer. So we do not call it as PET, we rather call it as interspouse transfer. See, husband to wife is individual to individual transfer. So if you are thinking of calling it as PET, don't call it. I understand husband and wife, they are individuals. They are human beings. But you don't call this transfer to be as PET exceptionally. You rather call it as interspouse transfer. And you try to keep the case of interspouse transfer separate. You don't call it as PET. And there, that will be a PET. So after labeling it, let's go to finally solve. Start the first one. The date of that has to be 30th of September 2016. And this is potentially exempt transfer. The transfer of value is given. The transfer of value is given as £800. Annual exemption. See, we have checked it. It's not a small gift. It's not even a normal thing out of his expenditure. It's not even a wedding present. It's not even between his spouse. So the only one exemption by default is applicable is AE, annual exemption. And I told you, the first, we have to use the exemption of that tax year itself. This is tax year 16 and 17. You definitely, by this time, can apply it. Means I guess you're no longer worried that, okay, how should it be falling into this tax year? Because people have done this with me in the past. You focus on to a day and try to see to which tax year that it belongs to. We easily can say that belongs to 16-17 tax year. So I'm going to use the exemption of this tax year first, and the maximum that I can use is 800, not more than. If I had to use an exemption of one last tax year, it would have gone this way, but we're not using. That process will be repeated for many number of times in this question. So this pro forma, I think for The application 2, you have seen it for the first time. And this all the way on a rolling basis, we will have to find the chargeable amounts of the rest of the transfers of this question. By the time that this question will finish, you will be all comfortable with how to find the chargeable amount of transfers after making the use of these available exemptions. Next one is CLT. Let's repeat this process. Which day was that being made? 31st of December 2016. And it is CLT. The transfer of value is given. £700. And then we have annual exemption. This looks to be a tax year 16 and 17. And take that from 16 and 16. So this is where I have to come and see if I will have something being left from this tax year or not, or fully being exhausted. Absolutely, it hasn't been exhausted full. 3,000 has been the limit, just about that much being used. So what has not been used is 2,200. And now we can come to use that out with this transfer. And safely we can use this 700 because we still have an option to use 2,200, but that is the best we could do. This, however, you have to keep on moving forward. That is called as chargeable amount. Okay, fine with that. Let's keep on doing the same thing. Looks to me like a repetition thing. Next one. 31st of July 17. There is going to be a transfer. Let's save a bit of a time on copying and pasting the pro forma, and we'll try to bring some modifications to it. This is CLT. The date needs to be changed. The tax year needs to be changed. The rest will not. The day is 31st of July 2017. The transfer of value is 1900. The annual exemption is 1718. See, just keeping an eye on this date. This definitely is an exemption of 1718 and 1617. This year's annual exemption I have never used ever, so I will be able to use the full 3,000. What I can use actually is 1,900. I wish I could use 3,000, but the value of the transfer is way less than 2,800. This is how the way you have to keep on finding the chargeable amounts of those transfers by preparing this pro forma. The next one is still CLT, I guess. Changing the date of it, the values of it. What has been the value of the CLT being made on 31st of Jan 2018? Well, the transfer of value is 1,400. The annual exemption is 1718 and 1617. So are we going to use an annual exemption of this tax year? Are we going to use an annual exemption of this tax year? So we will look up into our own solution and we will realize that out of 3,000, the 1,900 has been exhausted. So what we can still use is 1,100, and we are happy to use. See, been able to use it. And first time now we will get the chance to fill up this. So I will look back into my own solutions to see from tax year 1617 what I have already exhausted. 800, 700. So a total of 1,500 has been used up. And the 1,500 has not been used up, which I can take it down to next tax year, 1718 tax year, and will be able to use it. 1,500 been carried forward to this tax year, but I can possibly use only the 300 from. Now, any part of that is not used, further cannot be carried forward, because the 1 year carry forward is allowed. 1617's annual exemption can only be carried forward to this tax year only, cannot be carried forward further. Then it will be a waste. So you have to keep an eye on your own solution, because on the way, you're using it by yourself. So you go back to see, okay, this much has been used here, this much has been used there. So the total that has been used up is 1500. The total that has not been used up is the remaining 1500 that I only can possibly carry it forward to one next tax year, which is 1718, to be able to use it here. It's all about observing and finding and fixing in the end. Then comes the wedding present on 8th of May 2018. Has to be a potentially exempt transfer. Let me repeat that pro forma because consistently that pro forma needs to be prepared. Let me rub off those tax years. And this time, for the first time, I will be able to incorporate something important. And that important thing is marriage exemption. When you have got other exemptions to use, all the exemptions to be used in advance before the annual exemption will take a place after to it. Can't shuffle it. Follow this pattern. First comes the marriage exemption, then comes the annual after. Relationship is important. What is the relationship of donor to donee? Son, father, 5,000. Simply will come to subtract. The value of the present is 11,000. So that 5,000 can simply be deducted from. Good with that. And then typically we will fall back to annual exemption from 1819 tax year and from 1718. Have we ever used an annual exemption of 1819 before? No, we have not. So we will be happy to using this 3,000 from. Have we ever used an annual exemption 1718? I believe we have. Look back, you already have exhausted 1900 here, 1100 here. So nothing is there that can possibly be carried forward. I will not end up writing anything here. So this is all about observing by looking back into your own computations to see if any part was not used. You can carry forward. If all of that has been used, you are not allowed to. That's what I have not. Exactly, you can see. Then comes the interspouse transfers being made on 1st of July 2018. This one is an interspouse transfer. So you will not even call it as potentially exempt transfer. You will rather call it as, you will write the transfer of value. And then next to this transfer of value, you just can write it. Yeah, it is exempt. You will not even bother to subtract any sort of exemption because this amount 37,000 is fully exempt right now. So there's no point in subtracting an annual exemption out of it. This amount is fully exempt. Exempt. Next one, daughter. 30th of June 2018 is the last transfer of this question. The transfer of value is given. The transfer of value is 8,000. The marriage exemption does not have to come in. This is tax year 1819. This is tax year 17 and 18. So have we ever used an annual exemption of 1819 before? I guess we have used it. But to be sure of, you can look back into your own solutions. Check this out. Yes, we did use that annual exemption of 1819 fully. It cannot be used. Can we use the exemption of 1718? That was already been used up there. So no exemption can ever be used, can possibly be used that takes the value of this transfer to be the same as its chargeable amount. One thing that you may have not noticed that will help you. Don't forget to write down these tax years next to, because it's going to help you while you move on to the next page and you come to realize if I can use an exemption or not. You look back onto the previous page. The first thing that you look at is not the figure, the tax year that figure has been used from. So imagine if you're not leaving this space blank, you will be clueless from which tax year this 800 has been used from. So then you will have to go back to look into question once again. It creates the whole confusion. Time-taking task. Better to write the text here alongside. It will be informative for you. When the moment you will look back to previous page, it will give you that instant confirmation that this 800 has been used from this text here. This 700 has been used from this text here. And you will be able to use it or not. This process will become more smooth and quicker just by writing those texts here along. So make this habit to write it because it's going to facilitate you while you move forward. We are done with. That's how the way one has to find the chargeable amounts of transfers after making the use of all of those available exemptions. Finally, the time has come up to tax these transfers because you already have got those chargeable amounts ready and we are charging them. The next thing starts is the liability part. How to compute an inheritance tax liability. The band limits involved, the rates of taxes involved. We are now getting into that phase of the discussion. So inheritance tax liability computations. Inheritance tax liability computations. £1 to 325,000. The rate of tax is nil or 0%. If they go up to this mark, the rate of tax becomes what? The rate of tax becomes what? %20, 25%, and 40%. I've been able to write some multiple rates. This will require to have discussion. The first band that I did write has a name to it. It's called as nil rate band, NRB, because the rate of this band is nil. Any value of the transfer that falls into this will be taxed at nil rate. And the amount that will go up to that mark, the rate becomes either 20%, 25%, or 40%. This I still have to explain why and when this 20, 25, 40 has to be used. The 20% rate and 25% rate, these two are the lifetime rates. Lifetime IHT. And when you have to work a death IHT, the rate that we will be using will be 40%. Because right now we are focusing on the lifetime transfer, so we will be dealing with these rates first, and then we will be able to look into that 40% at the later stage. Within that, why it is 20, why it is 25? 20% is paid when the trustees, they have agreed to pay the tax. 25% will be used when it's the donor who has agreed to pay a tax on a transfer. Donor means the person who makes the transfer of an asset to a trust. If he or she agrees to pay a tax on, the rate of tax will be 25%. Or if trustees of the trust, they agree to pay a tax on, the rate of tax will be 20%. And these two are the lifetime rates. And that is what has been written over here. All individuals, they are entitled to NRB and taxed on a value of goods in excess over to 325,000 is the current nil rate band for the tax year 22-23. We are dividing this whole thing in three parts. Lifetime transfers in the life of person, lifetime transfers upon the death, and then the death state at the date of death. This will be going to be the focus of ours, that we are trying to tax the lifetime transfers in the life of person, because I've been telling you that you have to follow the sequence of nature. The life comes before someone dies tomorrow. So we must have to deal it with the lifetime tax consequence first, before when we will go to see the person has died and on that day what's going to happen. This needs to be lifetime transfers in the lifetime of individual. And there are two types of lifetime transfers, pets and CLTs. I take you back to that page to give you the reminder, which one is exempt in life, which one is chargeable in life. We're focusing on this right now. So don't you even look down to this. Just remember that in life, which one is chargeable, which one is exempt. Pet is exempt, CLT is chargeable. And that's the reason why when we are going to tax the transfers of the life in the life of person, the topic will revolve around taking the care of CLTs only. That's the reason why. Because pet in the life is not chargeable. Everything needs to have your attention. That why is this black box writes the CLTs in it? Because pets in the life are not chargeable. CLTs in the life are chargeable. So this topic will revolve around taxing the CLTs only. That is the answer to it. And then on the top of this page, I have given you a reminder that key thing to remember is that there are no inheritance tax implications on potentially exempt transfers in the donor's lifetime. However, there is an immediate tax arises on the CLT. That's the reason why the topic revolves around taking the care of CLTs. Unless or until we go to tax these transfers on death, we will just keep on focusing on CLTs, because CLTs in the life are taxable, pets in the life are not. Now you can exactly see me dividing this whole topic in two directions. Transferee pays the tax or donor. This discussion now will come to our way. That rate of tax thing that I was talking about, 20% by trustees, 20% by the 25% by the donor. This discussion will come back to our way. Trustees are in fact the transferees. This transferee is the one to whom an assets are being transferred to. And in CLT case, the assets are transferred to the trustees of the trust. So transferee right now is in fact the trustees. And donor is himself or herself, an individual. See, what do you see down under? 20%, 25%. That is this something I was talking about. 20% by the transferees and 25% by the donor. Whatever is there is here. The only difference of the two of the sides is in fact the rate of tax. We just have to complete ourselves with the one side. This side will automatically be finished. Just the rate of tax you have to respect. Will the question tell us about who will agree to pay a tax? Most of the times, the question will tell us that the donor has agreed to pay inheritance tax on, or trustees did. But in case the question does not specify, what do we have to assume? Do we have to make an assumption? This note then will help you. Donor is primarily responsible for paying the tax on CLT. So if the question does not state anything, then by default, it's donor who primarily, mostly, commonly, mainly pays the tax on CLT. So you will end up using 25%. That's the answer to it. Usually the question specifies. In case if it's not been specified, then the donor commonly pays the tax on the CLT that will make us to take 25%. Let's go and look into the first point. In the very first point, they want us to calculate the chargeable amount of the transfer by using the diminution value concept. Remember this diminution value concept, loss to donor principal, value before transfer, after menu, after transfer. So you have done this with me. So it's nothing new. After deducting the exemptions as studied above, for example, annual exemption, marriage exemption, small gift exemption. So the first point of this topic is something we are done with already, haven't we? But this application was requiring us to calculate what? This, in fact, is the step 1 of this topic. Calculate the chargeable amount. That's what this step is about. Calculate the chargeable amount after making the use of that loss to donor principal, and after making sure that you have deducted all of those available exemptions out of it, which is what we already have done. So this first point already have been done. We know how to calculate the chargeable amount of transfers after making the use of those available exemptions. This point is about just using the rate of tax. Which rate are we going to use? It means the only one point that's left for us to spend time on is this second point. What the second point is about? Now, the second point is like a backbone of this topic, because this is not going to leave us aside till the last moment. We will be on this topic. We will keep on using this. It requires us to look back into last 7 years. It requires us to look back into last 7 years, maximum last 7 years. What do we have to look back into last 7 years? We will have to see if any CLT has that been made ever before. If yes, then the value of it. Because with that value, it has exhausted the NRB. So we will have to spot it as if it's a radar and you're trying to spot an enemy in radar and it's blinking there. Remember, you used to watch that, the same in the movies sometime. There is a radar, and in the radar, they're watching it closely. If there is some suspicious activity, they spot it out and they reach up to that location. That's you're going to do it. You will look back into last 7 years to spot any transfer that has been made in the last 7 years. So if you have spotted any transfer, then by how much value was that for? Because by that value, it already has exhausted the NRB, part of the NRB. So suppose if I look back into last 7 years, I have spotted one transfer, the value of which is 100,000. So this 100,000 has exhausted the NRB and takes the NRB down to 225,000 now. Actual NRB is 325,000, but out of 325,000, 100,000 has been exhausted by the CLT being spotted in last 7 years. So now what I only can use is 225,000. So part of the NRB has been used by the transfer being made in the last 7 years. The remaining part, now we only can use it. Can happen the transfer that you have spotted has exhausted the whole of the NRB. That means today we cannot use any NRB. Or it can happen when you have looked back into last 7 years, nothing you have spotted. So the whole 325,000 is untouched, that you can use it today to tax this transfer. Technique you need to learn. Then any value you can find, no value may have you found, or you may have found a value that already has exhausted the whole NRB. That depends. But technique is look back into last 7 years to see if any transfer has ever exhausted part of the NRB. If yes, find the remaining NRB to use it today. If not, full use of NRB you can make that today. So how will this be doing? In a question, by taking the proper figures work, you'll be able to understand that and get the better taste of it. But if you wish to read it the way it's written word by word over here, I don't mind reading it. Take the care of previous 7 years before the date of CLT to look for any CLTs have been made prior to this one to check how much of the NRB being used already. By this way of doing, remaining portion of NRB can be found to be used today. That's the whole idea. So whatever is here is in fact the same has been copied here. So you do not need to really see what's being there. It's the copy and paste task. Just the rate of tax is different. Finally, let's go to apply that to our first application, application number third. With a lot of hardship, we are setting it up the whole of that foundation. These are the basics of those topics. And if you are not okay with those basics, never you can expect to get into those complex aspects and expecting to learn anything from. I always say, and I once again can say that the tunnel has one entry to enter from. And you cannot just enter into that tunnel midway, or else you already have entered and have covered the past half of that tunnel. The half of that tunnel is in fact the level 2 taxation course. So you already are midway into that tunnel, and then you just now need to exit it by traveling it for the remaining part of that tunnel. So if you have not entered into that tunnel, how can you expect to exit the tunnel one day? So this is how the way the whole thing has to be applied to your taxation course. You can't be good onto that first half of the tax knowledge. You cannot be expecting to be good onto that second half. Impossible. The mind will not even accept. Not you will be able to even learn it within the live sessions by not being okay with the first half. Giga makes a gift into a trust. So first of all, you have to see the type of transfer, is it? Definitely it's CLT. CLT it is. That is a value. No previous transfers being made ever before. Who agrees? Trustees. This is how the way the question will tell us. If not, I told you what you have to consider then. So let's start it all over again. 394,000, 9th of May, 2022. It's CLT. The question provides us with the value of transfer. $394,000. Annual exemption from tax year 22-23, we have to because it is a question in which I do not find any transfer other than this one. So the exemptions of this tax year and the last can fully be used. Because if the question does not provide us with any transfer of previous tax year, this is going to be an assumption that the whole of the last tax year's 3,000 has fully been unused. And you can bring that out into this tax year to top up. Check the sequence. First, this tax year's annual exemption, and then the next tax year. Although the figures are 3,000, so you should not be casual on that. Don't forget, I told you a very important thing. Why is it important to state that tax year alongside? This is what we call it as what? Chargeable amount. And that's what we have done so far in the previous application, 5-6 times. Remember that previous application were asking us to work this thing exact. And we have done that not for one time, not for 2 times. We've done that for about 6 to 7 times, this thing. So you already have become pro at how to find the chargeable amount of transfer, at least in the first place. Step 2. Now we will have to find the NRB. Which tax year are we into right now? And the NRB of this tax year is by default 325,000. I have been able to write this in inner column, sub column, because I have to find the remaining NRB, which will then be shifted to outer column. Next to that, I will go to write the transfers in last 7 years. Now I will look back into last 7 years. Now I will look back into last 7 years to see if any transfer has ever been made before, which has exhausted the part of the NRB, so that I can use the remaining now. But the question, when it says clearly this thing, we can become confident that no transfer ever we will be finding, even if I look back in. So nothing will be inserted here. That means the whole of the 325,000 can be used over. Any amount that falls within will be taxed at 0%. Any that will fall above will be taxed at respective rate. So in a systematic way, we're getting that value done. In a very systematic way, 388 minus 325,000, it's 63,000. In a very systematic way, we are getting that value done. This is that taxable amount to which I now can finally come to apply the rate of tax. The rate of tax will be 20 as the trustees, they have agreed to pay a tax on. The answer of that will turn out to be this much. With so much of effort, we have been able to reach up to that mark, that we have been able to find that inheritance tax liability on lifetime transfer in the life of person. Let's copy and paste this whole pro forma, because the next question that we are going to solve will be the carbon copy of A2. I will just concentrate on changing the figures. But now if I have to go and analyze this question, see, this is the first step of the topic. What is the first step? Recall the first step. Calculate the chargeable amount of transfer after making the use of any available exemptions. So that is the step number 1. What was the next step? Find the remaining NRB by looking back into last 7 years. This comes to be the second step, as we have been able to find the remaining NRB after looking back into the last 7 years. And what is the third and the last step? Apply the rate of tax. Now you can understand how much importance you have to give it to these steps, because you cannot shuffle those. It's one after the other. You cannot shuffle those. And you cannot bypass the one step. Means you cannot just do this and directly do this. You have to do this on the way. You cannot bypass. And you cannot start answering your question from this without doing this. Has to do this first, then this on the next, and then in this in the last. The whole thing becomes a lot systematic when you will go and follow these steps involved. It's like 3 boxes and you have to assemble them. When you assemble them, it becomes the whole solution. But each box, what happens within it you have to be good at. That, okay, in first box, I'm good with how to work the chargeable amount by making the use of available exemption, marriage exemption, wedding exemption, annual exemption, normal expenditure, small gift. Then in the second box, I have to be good looking back into last 7 years to see any transfer has ever exhausted the part of the NRB so that I could find the remaining one. Then in the third box, it's about using the rate of tax 20 or 25, depending upon who has agreed. And then I have to assemble all those boxes to form the whole solution. And I cannot shuffle those boxes. Has to be this way. How easily the whole thing suddenly starts looking when you have been given a very nice way of understanding. That pretty much ends up this page. Do you see anything on this page being written and I've not looked upon? We start the page and we gradually finish it up, we do not realize how have we finished it up. You on the other side get the confidence of that we are covering it everything in the lecture notes. And it's not about reading those lecture notes. It's about getting the board explanation first. And then I get back to show to all of you what and where and how the things are written back into lecture notes. And gradually you realize everything is done and dusted from any page. The part of the topic that we have finished, 4 or 5 pages, there's nothing being left on any page, on any corner of that page that we have not touched or we have missed it out. Good with that. It now has become a machine. You will input a raw material, it will produce a product. If you will not have anything to put in, the same will fit over here. It has become a lot mechanical that you will never be confused about. As long as you have spotted the value right, you will just come to insert that value. Let's say 100,000. This will become 225,000. If this will become 225, this will be figure depending upon that. If nothing being fitting in, the whole 325 will be shifted to outer column. Or if the value was 400,000, suppose, nothing will come over here, because in that case, the whole of the NRV would have been exhausted. The whole will become taxable. So it becomes a lot mechanical with this pro forma. That's just applying the rate applying the rate of tax, nothing so difficult. Now we can take the next question, which will be the same as above. Only the difference is the value of the transfer has changed slightly. And who has agreed to pay a tax? She herself, donor. That's the reason why I was wanting to copy and paste this whole pro forma thing, because it will save definitely a lot of time. This one was application 3. This one is application 4. We will be able to contrast the two without having to solve the entire. So the date is same, the value is different. The value is 414,000. And I guess the annual exemptions will be the same, because the value, because the date that transfer was made is in fact the same. So I'm okay with 414 minus 6 equals to 408,000. I did not see any transfer in the last 7 years. So the whole 325,000 is available. 408 minus 325, that's about 83,000. The rate of tax is going to be 25%. That should be 20750. End of a story. What and where have you noticed a change in it? Nowhere. Just because the value was changed. Nothing has changed. In the end, the rate of tax has changed only. 20, it was 25, it has become. No big change has been witnessed. Now, this pro forma is that much, is that one that we will keep on repeating with the topic to go by, no matter whatever we have to do in advanced aspects, whatever we are doing it right now. Till the end, we will keep on preparing this pro forma. Importantly, one thing that you have to also keep into mind, you see, I always insist on to these things, even within the classes, claim dates and deadlines, even while discussing the capital gains taxes, claim dates for the reliefs, deadlines to pay the taxes, has always been the part of a talk. So by when we are supposed to pay inheritance tax, lifetime inheritance tax, not death. Today we are alive, making the transfers of assets to trust. By when the taxes will be paid by the donor onto it or by the trustees onto it. All depends if the gift is in the first half of the tax year or in the second half. First half runs from April to September. You can count it by yourself. Your tax year starts on April. So April, May, June, July, August, September. That's the first half of a tax year. The second half will start from 1st October. October, November, December, Jan, Feb, March. So if the gift is in the first half of the tax year, the deadline is 30th of April, following the year of gift. And if the gift is in the second half of the tax year, we will have to count down the 6 months from the end of gift month. It's all written there for you to look at. And ultimately, remember that will be your sole responsibility. I can just convey that once and can apply that into a variety of questions. But at the end of the day, to remember this rule of law is totally your responsibility. Does not have any logic or science in it that I can give it to you and then you can remember it. By only revising it, you will be able to remember that. 30th of April following the year of gift, if the gift is made in the first half, 6 months by the end of gift month, if the gift is made in the second half. So applicable to our questions, this looks to me the first half of the tax year. Yes. So the deadline to pay a tax should be by 30th of April following the year of gift. This is the year of gift. So following the year has to be 23. The day has to be 30th of April. That how the way you have to be so much fluent on the basic aspects by being a student of advanced taxation. And this is what the course demands from you. Have to be so much fluent on whatever we are doing so that later this technical knowledge can be applied in performing exam style questions. What else I have to explain before I move forward to next application? Something that is called as gross chargeable amount. I can write it down the bottom, gross chargeable amount of transfer. This gross chargeable amount of transfer, we have to work for future considerations. Means, if I have to tax this transfer in future, again, and what is in the future? Death. So in other words, if I have to tax this transfer upon death, right now we are taxing this transfer in the life of person. But in case if the same transfer becomes taxable upon death, what amount will be used to apply the rates of taxes? That one will be this one, 388,000. This amount will then be used to apply the rates of taxes to, or this amount will be used in death computations for this transfer, 388,000. We're not taxing the death transfers right now. We're just finding that figure that tomorrow we can use it upon the death computation. That amount will be 388,000. It's not going to be this one. It's not going to be this one. It's going to be this one. Yes. What will be the amount in this question that we will be using for death computations in future? It should be this one as above. Should be this one as above. Why don't I try to save this pro forma first rather to annotate it any further, because I might be using this pro forma many odd times in many next questions coming to our way. So we can save a lot of time. So I keep that in reserve as a draft and we'll use it. Now I can do a lot of annotations over to it. This is that amount to be used. Fine. But it also will take this one. Now I can tell you the whole logic of that. Why? Because in the previous case, I only have taken the value. This time I've even taken this one. Let me first get myself done with the value, and before I can then comment on why is it a difference? Why have we used this amount here when in the previous case, we're using just the value of transfer? This is going to be the value to be used in future consideration where this will be taxed in future. Upon the death, this value will be used to apply the rates of taxes to. So why in this case, I have been able to incorporate this value over to this, where in the previous scenario, I did take only this, should have taken this one also. What's making the difference into that? This is what I was wanting to explain after completing the two same solutions. Why in this case, the 388,000 has only been used a chargeable amount, whereas in this case, on top of chargeable amount I have used, I have been able to top this up in this value also. Because this time, it's the donor who has paid a tax on. When transferee they agree to pay a tax on, this will not be topped up in it. When donor they have agreed to pay a tax on, and even has a logic in it. See, when this topic started off 2 hours ago, almost 2 hours ago, we have been in the course right now. We started the topic with the definition of transfer of value. And the definition was gift of asset that brings the reduction in the value of donor's estate. Reduction in the value of donor's estate. So I, being a donor, have taken this thing out of my estate, firstly. Secondly, the cash has also been taken out. So two things will bring a reduction to the value of my estate. So the total value of transfer for the future considerations will be this. Whereas in this case, donor has not paid it. Trustees, they have paid it. Donor only has taken this thing out of his estate. So that will be the value to consider for future consideration. Now you get the whole reasoning of that one. Reduction in the value of donor's estate. Two things will bring reduction. To find me the full value of the transfer. But here in that case, it only will be this, since this amount has been paid by the trustees of the trust, not by myself himself. Got it right? This should be remembered. Very important point that later you will have a chance of making a blunder at it. Don't forget, when donor pays the tax over to the value of the transfer, then for the future considerations, the value of the transfer will involve the tax amount also within it. But when the trustees, they have agreed, only that value will be used for the future computations. You can easily contrast these two. When you will come to revise the whiteboard explanations, you will be able to see the difference of two. Everything that is on this page exactly being written onto this page with minor differences. I can try to even draw those boxes around if you want this solution to be even more familiar to the first one. Now it gives us the same kind of a feel. I even can copy and paste the steps. These two same solutions. And the difference, you can easily point it out. The difference is over here. First. Second, over here. Otherwise, there's no difference. On top of the figures, changing the figure is not a difference. Well, that are obviously the facts of the question. Exactly the difference that you can spot is the rates of taxes being used. Secondly, the chargeable amount gross over here does not involve the tax here, which in that case has involved. Okay with this? Fine. Let's go to take a break for 15 minutes. And when we will resume the session, we have got many things coming to our way that you cannot expect to or afford to miss it out. I will see you in 15 minutes to resume the course. Stay tuned. Okay, I'm back. Hoping you're also there with me in the continuation of the course of today. This application 5 will be a revision of what we have done in these two questions. But because this question involves various transfers, so you will get the chance to really fill in this bracket with some transfers in the last 7 years. That's only going to be the difference. So we have got that pro forma ready for us, and this will save a lot of time as all of those transfers being given to us will pass through to this thing. So I have this thing saved and now can come to use it while working the answer for application number 5. Let's do it quickly before we can take ourselves down to the next phase of the topic right afterwards. Application number 5. During the lifetime of Kate, had made the following gifts, providing to all of us with CLT. This is going to be PET. It's going to be CLT, CLT. And then they're providing to all of us with the respective nil bands, calculate the inheritance tax arising as a result of Kate's lifetime transfers. So we'll start off with the very first one that's being made on 25th of May, 2020-21. The transfer value is given as 91,000. Annual exemption for which tax year we're going to use it 11-12 and 10-11. So once again, we've been able to find that chargeable amount, which is what we are about to tax. Now, because we are taxing the transfer in the life of person, so we will use that tax year's NRB to tax. That tax year's NRB is given as 250,000. The transfers in the last 7 years. Obviously, I'm into a first most transfer. So even if I look back to last 7 years for 10, 20 times, I will not go to spot anything. So whole of that NRB could have been used. This makes me to say that the taxable amount has turned out to be 0. And IHT, who has agreed to pay a tax on trustees at the rate of 20%, will give us no tax liability. See that process? Repeating and repeating and repeating. Every next question you go in, that pro forma comes back to away, and we just apply that process of getting those answers done. Good with that? Okay, what's next? The next thing is PET, and this is being made on 19th of July 2016. 19th of July 2016, potentially exempt transfer. The question provides to all of us with the value of transfer, which is given to us as 155,000. The exemptions we can use the tax year 16-17 and 15-16. We have not used the exemptions of both the tax years ever before. This has become chargeable, but then you realize it is potentially exempt transfer. So you will be able to write it very next to no inheritance tax is payable in life as it is exempt. Potentially exempt transfer is exempt transfer in the life, so we have not been able to work any sort of tax on that. Chargeable amount of that has been found, but you had not seen me taxing it using the NRB or any sorts of rails. Next thing, 23rd of March 2017, we have CLT, chargeable lifetime transfer. Copy and paste this entire pro forma to save a lot of time. Okay, so this can save a lot of time. The value of that is 234,000. This tax year looks to me from tax year 1617 and 1516. Have we used the exemptions of both the tax years already? Yes, we have. I exactly can see the two of those exemptions being used. So when I cannot use any of those two, the whole of that amount becomes chargeable. I can come down to double check. Yeah, this is tax year 1617. The NRB of this tax year is given as 300,000. Yeah. Now, finally, when I look back into last 7 years, I will certainly go to spot something. So look back into last 7 years. I can go back till 2010. And both are within the range. But the first one is CLT. The second one is PET. This, although is in the last 7 years, but it hasn't exhausted the ban because it is exempt in life. This is the only one who has exhausted the ban. So I will go and take the value of it, 85,000, and will come down to peacefully insert into it. This gives me the value of 215. Now, this is for the first time I have been able to fill in something in. And you have seen the process of doing. This was the day I was standing. I could go back till 2010. I could go back to 2010. I can spot both the transfers in the last 7 years. This one is PET has not exhausted the band. This definitely has. So I've gone back to that side and have been able to take the value of it, 85,000. But this is that process. On a rolling basis, you keep on revising. And you have to have a command over to it before the complications will step in. Who has agreed, Kate, 25% rate of tax? The answer of that has to be 4750. Well, taxable amount has been found. The answer turns out to be 4750. Good with that. Something important, we can try to find the value of the transfer for our future consideration. Gross chargeable amount of this transfer future considerations will not just be 234,000. Also the 4750, since donor this time has taken the two things out of the state. So I will have to top this up and to find that amount for the future consideration. That's going to be 238750. 238750. Good with that? Done, no problem, got it right. Moving on to the next, the last one. Trust transfer. 373, the date is 22nd of October 2022. So the whole of that process needs to be repeated. Let's copy and paste the facts and try to bring the change into where it is required. Okay, so the transfer of value is 373,000. The transfer of value is 373,000. Annual exemption. Which tax year I should be taking it from? That looks to me a tax year 22-23. Yeah. Can take tax year 21-22. Have we used the exemptions of both the tax years previously? I bet not. No, we have not. So we can safely use the exemption of this tax year and even the previous one. That takes the total down to 67,000 pounds. The NRB of this tax year by default is 325,000. Transfers into last 7 years. Let's redo the same path. 2022, I can go back till 2015. Within that range, this one comes in. This one comes in. But this one was PET has never exhausted the band. So the recent one, the only one will qualify. So let's go to take the value of that transfer. The value of that transfer has just been finalized to be as 238750. I will be able to simply come and fix it in. That is what one has to do. Observation. So 238750 minus 325,000, the figure turns out to be 86250. The figure turns out to be 280,750, and trustees, because they have agreed to pay a tax on the rate of tax, the answer turns out to be 56150. Pretty much the end of this entire question in a space of hardly 10 minutes. How many times this process of preparing this pro forma I have revised? And by this time, people have probably become pro at. Naturally, it has grown to that level. Not the first minute I started the topic, I started off with this kind of a question. Gradually, part by part, we have been able to reach at the stage where we are okay with all of these lifetime computations. Let's go to revise one more thing, the due dates. First half, second half. Looks to be the first half. So if I have to pay a tax, I will be paying it by 30th of April following the year of gift. That should be 2012. PET obviously is not taxable. This looks to be a second half. So for second half, we count down the 6 months by the end of that month. So I will have to come down to the end of that month, which is 30th, 1st of March, and then 6 months to count. April, May, June, July, August, September. That looks to me first half. No, second half. Yeah, October is the second half. So let me count it once again. April, May, June, July, August, September. This is first half. The second half starts on October. So that is exactly second half. 6 months by the end of that month, which means I have to come down to the end of that month, which is 31st of October, and count 6 months from. That's going to be November, December, Jan, Feb, March, April. This fluency I demand from you as a student of advanced taxation. Is it too hard? Your level has to be a level of advanced level student. And because of that, all of these basics must have to be so much fluency you have to have. You must have to have. Everything that you are working it out, you must have been aware of due dates of payments, who has agreed to pay a tax, or rate will be 20%, 25%. Gross chargeable amount for the future transfers will be this. So everything on top of just working the liability alongside, you must have been revising. And see, for the very first time, you've been able to see me filling up something into that bracket. And this was so easy to observe. Stood on to that date, look back into last 7 years, have analyzed 2 of those transfers in the last 7 years. But then I have realized this one is the PET. Never exhausted the band because it's not taxable in life. The only one that had exhausted the band in the last 7 years was this transfer. So I have been able to take the value of that. That process was repeated in this. Once again, 2022, I could have gone back to 2015. 2 of those transfers were within the range. This had never exhausted the band. So the one that had exhausted is this one. So we came down to take the value of that. It's that process that is never ending. On a rolling basis, it continues the same way. Rate of tax in the end, 20, because trustees, they have agreed to pay a tax on. Here it was 25 because donor was paying the tax here. That pretty much ends ourselves with the first leg of this liability computation. We all have become pro on how to calculate lifetime inheritance tax on lifetime transfers. Next up, taxing the lifetime transfers upon death. So we are still taxing the lifetime transfers, but upon death. This will take us back to those rules which I was sharing to you earlier on. Now we're going to make a use it. These rules, we are going to make the use of it because now the time has come up that we're going to tax these transfers of the life upon the death of individual. And these rules are same, no matter if we have PET or if we have CLT. What are those rules? They say that if the donor dies within 7 years of making a transfer will become taxable on death. If donor survives for 7 years, it will be exempt on death. So that survival or death in 7 years needs to be watched out, because that's what make you decide to tax which transfer and which not. So automatically you will be able to remember these rules as we are going to make the use of it right through. Let's go to land onto that page this discussion is starting from. See, IHT liability on lifetime transfers, but this time at death. Earlier on, IHT liability on lifetime transfers in donor's life. So this is where we have now entered into a second leg of the topic. Taxing the same lifetime transfers, PET CLTs, this time on the death of person by observing if the death is in the 7 years of making the transfer or the survival for 7 years. And this topic even has got steps. In the very first, they want us to identify the transfers of last 7 years of death, which is a true reflection of those rules. We have to spot those transfers, those are in the last 7 years of death, because those will only be taxable. If any of that transfer that is not in the last 7 years will be exempt. So that's the first thing, observation. Spot, highlight all of those transfers, those are in the last 7 years of death, and concentrate only them. And then the second step is about the same typical one. Find out the remaining NRB by looking back into last 7 years. So this looking back into last 7 years and finding the remaining NRB thing is not going to leave us aside till the end. So that does not need to be explained. We know this, how to look back into last 7 years and spot the transfer and see the remaining NRB. That will be the same thing as above. And finally, the rate of death tax. As I was telling you earlier on, the rate of death tax is 40%. So take yourself out of that 2025 thing, because those rates were lifetime rates. We're taxing the transfers on death, and the death rate of tax is 40%. Don't look into fifth step. Keep yourself till step number 3rd, and we have a very small application to solve onto these 3 steps. Before we will learn the 4th and 5th step, we can work this one to at least get ourselves done with the first 3. Application 6, an application on 26th of December, David made a transfer of 384,000 to a trust. He has made no lifetime gifts. The IHT due in respect of this gift was paid by David, donor. Since the start of the topic today, first time we have seen the question has referred someone has died. And it has a reason, because now we are starting to tax this person on the death. Never the case before in any question we have seen the death of any person. First time the question includes the David died on this date. We have been asked to calculate the IHT in the lifetime and additional IHT as a result of death. State who will pay the IHT and the due date of payment. So we know the due date of payment, we even will be able to state who will have to pay tax. Because on CLT, trustees, they pay tax, if not donor. Okay. First of all, we are working on a lifetime IHT. Lifetime IHT. So we'll start it all over again, 26th of October. Why don't I copy and paste this pro forma? Several odd times we have prepared it first. So we will keep on copying and pasting. It will require us to repeat that process one more time. So the day is 26th of October 2017. The transfer value is 384,000. This tax here looks to me is the tax year 1718. So I'll be using the exemption of that tax year and the previous one. And both of the exemptions I can happily use since not being used ever. That takes the value of the transfer down to 378,000. If I look back into last 7 years, I clearly have been told no lifetime transfers ever being made before. So the whole of the NRV still I will be able to use over here. So 378 minus 325, the figure turns out to be 53,000. No. Importantly, we are taxing the transfer in the life of the person right now. So we should be using the NRV of that tax year. I just have realized. See, we are taxing the transfer in the life of that person. So that tax year's NRV we have to use. See, the question, although focusing on death, but let me remind you of one thing once again. You cannot bypass the lifetime tax consequences. That by anyhow will come on the way first. See, you cannot bypass the lifetime IHT on the way toward the death IHT. This will definitely come on the way as above. Then after that, we will get into a death IHT, which is the topic of the moment. But on the way, we have been able to do the same that we have done in the past whole 1 hour. Taxing the lifetime transfer in the life of person. Who has agreed to pay a tax? They definitely have said David. So the answer of that turns out to be 195. And here I can find that gross chargeable amount, the way that I always find for future considerations. It will not just take this, it will also take this. So 378,000 plus 19500 becomes 397,500. Who give that? Who and when? Who will pay a tax on that? David himself. They have said it that the David has taken a responsibility of paying the tax onto it. So by when looks to me like a second half. So second half is 6 months by the end of that month. So the end of that month is 31st of October. And those are going to be November, December, Jan, Feb, March, and April. 30th of April, 2018. April 2018. 30th of April 2018. So this is something that on the way you have to revise, because this will automatically be the way you'll be able to remember these deadlines if you will revise it so often being the part of your computations. So far, whatever we have done is in fact a recap of what we have done before. Now what we will do is going to be the topic of the moment. Death IHT. Let me put the heading up there. Death IHT. This is the topic of the moment that we are now interested in understanding. So first thing first, we will have to draw a timeline, or you can say lifeline. This is the day the life of his ends, the day of death, which is 30th of November 2022. And 7 years before, I can try to put a mark 7 years before. So 7 years before, the date will be 1st of December 2015. If you're done, you should have to start counting it forward to see if this date you have written is right or not. So 16, 17, 18, 19, 20, 21, 22 looks to me fine. So this is the mark 7 years before I have been able to make. What needs to be done? The transfer that has been made, I will see if that comes within that or out of that. 26th of October, fairly looks to me comes within. Yeah, 26th of October 2017, easily noticed over here. So it is a chargeable life transfer. and we have identified it into the last 7 years of the debt. See, which step are we working on right now? This, in fact, is the first step. Identify all the gifts within the last 7 years of debt. This is what it means to say. That's identification. We are trying to identify the transfers are within the last 7 years of debt or not, is in fact the step number 1. So let me write it onto the left-hand side. This is a step number 1. You cannot bypass it. Without identifying, how will you be aware of which one is to tax on death, which one is to exempt on death? Imagine the same question could have 2 to 3 transfers. This question only has 1, so it looks easier. The question that we are going to attempt afterwards will have plenty of coming to our way. See, check this out. So what you are applying and getting to know will be used into that also. So learn it with 1 transfer. There we will have 5 to deal with. I mean, the same 5 transfers, I will be plotting it on this timeline in that next question. But at least get yourself done with the 1 transfer, which is within the last 7 years of debt, which is the step number 1. Therefore, we are taxing this transfer on debt. So write down 26th of October. It was CLT. And the chargeable amount of this transfer, we have to copy and paste from the above, 2,397,500. See? Now, in debt computations, we are going to use it. How much important is that to respect every little thing? We are not using this only. We're using the collective balance. And then we will fall back to that typical NRB. In which tax year he died in? Tax year 22-23. So this tax year's NRB is 325,000. That one we are going to use. See, while we were taxing the transfer in life, we did use the lifetime band. Now we are taxing the transfer upon death. So we are using the death tax year's NRB over here. These are the things to notice that later you might have a chance of mixing it up. Or later you will have this question that sometimes the lecturer is using this, sometimes is this. What's the confusion going on? This was when we have taxed when he was alive, in her life, in this tax year standing. But now we are taxing the same transfer upon death. So death tax year's NRB will be used. Transfers of the last 7 years. The same technique of looking back into last 7 years. So see what I'm going to do. I will go to stand onto this day and will count further 7 years from. This should be the technique. Stand onto this day and look back further 7 years from that mark, as I am, to spot any transfer. Unfortunately, I haven't spotted any. So I will be able to write nothing into. The whole 325,000 will be available for B2 tax. So look back further 7 years from that mark to spot any transfer, which we have not spotted. This will be the technique to be used, and it will become more interesting when you will have multiple transfers in one question, which is going to be the next question. After a while, we will get into. The death rate of tax is 40%. Instead of using the 20 or 25, I have been able to use this much. The process is still the same as above. Look at that. This is the first step. Good. This turns out to be the next one. Find the remaining NRV, looking back into last 7 years. This turns out to be the third one. So again, I'm going it the way that I was going by in the case of lifetime taxation. You cannot just be casual about using those steps, or you cannot shuffle, or you cannot bypass simply one step on the way, because all of these steps are in continuity. Step 1, Step 2, Step 3. Step 1 was about identifying the transfers into the last 7 years of death. Step 2 was about finding the remaining NRV by looking back into last 7 years. Step 3 was about using the rate of tax, 40%. Now we are heading towards the step number 4. What the step number 4 is about? Step number 4 is about giving a relief. The name of that relief is taper relief. Taper relief is available in variety of percentages, 20%, 40%, 60%, 80%, depending it upon the whole of that gap in between the death day and the gift date. Check this out. This is the date of gift. This is the day of death. So how many number of years we can find it in between? 18, 19, 20, 21, 22. 5 years. Still no death because this is 26th of October. So if after 5 years, I will land on 26th of October, 2022, and still there is no death, the death is in the next month. So it means 5 years have fully been completed. 6 years have not. So if I go into a table of taper relief, I will end up using 60%, 5 to 6 years. And the liability will be reduced by the effect of that 60%, 29,000, 60%. The figure turns out to be 17400. Okay with that? 17400. 17400. It can be 40%, it can be 30, it cannot be 30, it has to be a step of 20. 20, 40, 60, and 80. All depends on the gap in between the day of death and the day of gift, which you have to observe. It's all about observing. 26th of October, 17, 18, 19, 20, 21, 22. 26th of October, 2022. Still no death. So 5 years have been done, 6 years cannot be. So it's 5 to 6 years, makes me to choose 60% from that chart of taper relief. Taper relief chart will be given to you in exams. But you still can remember it as 3 to 4 is 20%, 4 to 5 is 40%, 5 to 6 is 60%, and 6 to 7 is 80% maximum. That is taper relief. Check the step number 4, the way it's been written back into your lecture notes. Calculate and deduct any taper relief available depending it upon the time that is in between the gift day and the day of death. That's been done also. So let me highlight this to be as the step number 4. And now we are heading towards the step number 5. What is the step number 5? IHT already paid. If any of the tax on this CLT being paid in the life before, I will have to come and deduct. Before I do it, let's go to find the liability. We have it with us after relief. It's 29,000 minus 17400. It's 11600. It's 11600. This is the tax liability after taper relief. But now we will have to see if on the same CLT in the life, this person has paid a tax, he will be able to get a credit of it. Otherwise, it will be a double taxation because on the same CLT in the life, he has paid a tax. Now on the death, he will become liable to pay more tax on. So the same transfer being taxed twice and double taxed. So to give that person a relief, we will have to come and subtract the IHT that has been paid in the life from this bracket. And for that, we will look back into the lifetime consequence and got to know that this is the tax that he has paid on, and we will end up subtracting from here. This turns the liability balance down to 0 or negative. Negative. So the liability can go down to 0. Refunds cannot be created. That is where the 5th step also has come to end. Now you can see how much important is that to go step by step. Otherwise, no chance that you will be able to complete this off. I know the answer is turning out to be a negative, which is a refund. That cannot happen. Liability can go down to zero. Refunds cannot be created. That pretty much ends off the talk of step number 5. Deduct any IHT being paid. It can reduce the liability down to zero, but will never create refunds. Systematically, all of those 5 steps I have been able to complete. That is a chart of taper relief. We already have done, haven't we? We have. Due date of paying the tax at death. So for tax payment on death, we do not have to get into first half, second half. Rather, we just have to remember 6 months by the end of death month. So applicable to this case, this is the day of death. It's already end of that month. So we will have to simply count 6 months from that mark. That should be December, Jan, Feb, March, April, May, 31st of May, 2022. 31st of May, 2022. How nicely we even have been able to complete ourselves with the second leg of the topic. Except this one long question is left, which we can solve this out in probably by spending the next 15 to 20 minutes on. But it will be a recap of what we have just done. With one transfer, you will repeat the same with 5 transfers. Before we will take ourselves down to the third leg of this topic in a while. So let's get ourselves into application 7, because all what you have done in this will be revised for 5 odd times, same way. But it's good because this will create a confusion, as on this timeline, you will expect to have 5 transfers. That can cause a little bit of confusion. Adam has made the following lifetime gifts. So these are the lifetime gifts. The first one being CLT, the second one being PET, third one being CLT, fourth one is being PET. This one is CLT, so I can write it CLT, PET, CLT, PET, and CLT. Adam has agreed to pay any IHT due on CLTs. Adam died on 1st of Jan 2023, and the nil rate bands for the earlier years are as follows. So they have provided to all of us the same sort of a fact, except now we have got 5 of those transfers to deal with. So it will be so much repetiting. In the life, Adam has agreed to pay any IHT. So the rate of the lifetime taxation will be 25%. That is a day of death. Respective NRBs they have provided to all of us. So let's take ourselves down to this to solve this question as quick as we can, because most of the stuff in that question will be quite a bit of a revision, and we should be doing this to feel ourselves so fluent at it. Application number 7. So Adam has first of all made the transfer of 99,000 to a trust. So we guess we have to come and repeat that performer, so I can save a bit of a time by copying and pasting this performer. CLT being made on 1st of November 2022. The transfer value is given as 99,000. So we will take an annual exemption from that tax year. This looks to me 22, 23. And we can safely use the exemption from both the tax years. That takes the total down to 93,000. That tax years and the NRB has to be used because we are taxing the transfers in the life. Let me put this heading, lifetime IHT. In the first place, we focusing on lifetime IHT. So what has been the NRV of, oh, that's not 22, that's 2012. So I was wondering, how come? Yeah, this is 2012, so it's gonna be 12, 13, and 11 and 12. Yeah. So NRB of 1213 is given in the question as 250,000. The transfers in the last 7 years cannot find any because that's the first one we are into. So even you look back into any of those years, you're not going to spot any single thing. So nothing becomes taxable. IHT at 25% will even be 0. Good. Next one. And the next one looks to me a potentially exempt transfer. So let me rub off all of those things and wait for, in fact, this needs to be rubbed off since the pet is not taxable. What is the date the pet has been made? 1st of August 2016. The transfer of value is 269,000. Annual exemption from which tax year? I can take that 16-17. That's 15-16. Can we use the annual exemptions of both the tax years? Yeah, we can because we have never used them before. That takes the total down to 263,000, and then I will come to repeat this statement that I was writing that in one question above, which I can copy and paste to save a time. No IHT is payable in a life as it is exempt. Now let's take ourselves down to the third one quickly. Third one is CLT. So whole of that pro forma of computation will get back to our way. It's 240,000 CLT. Annual exemption from this tax year. No, this is 12-13 and 11-12. I guess we will not be able to use. We can look back into our own solution. 12-13 annual exemption has not been used. Oh, this is not this date. I'm writing a wrong date. 1st of July 17 it is. 1st of July 17. So tax year 17-18 and tax year 16-17. Can we use the exemptions of both the tax years? 17-18 exemption has never been used, but 16-17 has been. So I will be able to use the exemption of this tax year only, but not this. Takes the total down to 33,000. NRB of 18 is given as 300,000. Now, especially when I look back into last 7 years, I will go to spot something. This is the day I'm standing it on and looking back, can go back to 2010. So I can spot both the transfers in the last 7 years, firstly. But the recent one is PET has never exhausted the band. This only has. So I will go and take back the value of it, which is 93,000. Is this the way that I have worked the question so far? And you have that impression that it's the same stuff going on. So let me be a bit quick on that. It's the revision of revision. So revision of revision. That is 7,500. And then here we will come to find that gross chargeable amount for the death computations, which in this case is going to be 7,500 and 300,000. 307, not 30,000. It's this value, 237. 237,000 plus 7,500. That's going to be 244,500. 244,500. 244,500. Okay. 244,500. Then comes another potentially exempt transfer, very next to. So just need to come and change the figures. The dates, the date of that is 1st of December 2019. 1st of December 2019, and it's bet the value of the transfer is 27,000. The annual exemption is going to be used from 1920 tax year and from 1819. The transfer of value is given as 21,000. No, 27,000. Can we use the exemptions of both the tax years? Yeah, we can, because we do not see any of that exemption being used from these two tax years. It's 21,000. No IHT is payable in life and is exempt. Moving on to the last one, which is a CLT one more time. So 83,000 has been the value of it. 1st of September 2020. It's 2021 and it's 1920. Can we use exemptions of both? No, we cannot use the exemption of 1920 as it has been used exactly before. So I'll end up using the exemption of that tax year only. That takes the total down to 80,000. This is 325,000. Because for tax year 2021, it's this. So looking back into last 7 years, I can go back till 2013. And I can spot 3 of these transfers within. This one is PET, this one is PET. Never exhausted the band. So the only one that's exhausting the band is this C. So let's go to take the value of that. The value of that is 244,500. This is this science. The moment you gain a command over to that, you will be feeling so comfortable about that. It's easiest. 80500. No, 244,500. Let me check if it is the same answer. Yeah. So nothing when will become taxable, the liability will turn out to be 0. So we have ended ourselves with the lifetime IHT on these lifetime transfers. I can do this one more effort of writing down the due dates along. This looks to me the second half, and for second half, we have to come down to the end of that month and count 6 months from. This is going to be December, Jan, Feb, March, April, May. It's going to be 31st of May 2013. This looks to me the first half. So for first half, the due date is 30th of April following the year of gift. This looks to me the first half. So that is once again going to be 30th of April following the year of gift. After completing ourselves down to lifetime, now we are heading towards the death IHT. This will require me to what? Draw a timeline. Let's follow that technique. The day he dies on, the day of death is 1st of Jan 2023. 7 years before, the date must have been what? 7 years before, the date the 1st of Jan 2016. Let me just double check. 16, 17, 18, 19, 20, 21, 22. 22 means 31st of December 22, which means the same 1st of Jan 23. So it's fine. This definitely is not with incoming. That's November 2012. So I will definitely go to write this amount over here. 1st of November 2012. And to add with, this was CLT. The next one is August 2016, and this one is coming within August. 1st of August 2016, and it is potentially exempt transfer. The third one is 1st of July 17, and this one is CLT. Then comes the PET on 1st of December 2019. Then comes the CLT being made on 1st of September 2020. So 4 of those transfers are within the last 7 years. The first one is not within. So this one is not going to be taxed. These 4 of them are definitely going to be taxed upon death. Okay with that? So let's start ourselves with the very first one, which is not even the last 7 years. I will go to write the chargeable amount. What has been the chargeable amount of this transfer? So I'll have to look back into my own working. That is 93,000. No IHT is payable. No IHT is payable as it does not fall within the last 7 years of death. Within the last 7 years of death. No IHT is payable as it does not fall within the last 7 years of death. And that's the reason why we're not taxing it, because it does not fall within the last 7 years of death. Moving on to the next. 1st of August 2016, there is a potentially exempt transfer. There is a potentially exempt transfer. And the chargeable amount of that, we can copy and paste it from the lifetime computations. It's 263,000. This one is definitely going to be charged upon death. So I will come down to write this NRB computation thing. The death NRB is by default 325,000. Transfers into last 7 years. Remember, I told you we will have to come back to that day itself and spot the transfer by moving back this way by. So we are further looking back into last 7 years by standing it onto that day. I can go back till 2009. And that is 2012. Something we have spotted in last 7 years. The problem is that this CLT is exempt. First thing that you have to be good at spotting the transfer in the last 7 years, which we have spotted. So you have to stand onto that transfer and further look back 7 years from that mark and spot the transfer, which is what we have spotted. Then the second thing that you have to ask to yourself, has that ever exhausted the band? Has that ever, the word ever has been used. So ever means, if not on the death, it is exhausting, may in the life it has exhausted. Or if not in the life, may have exhausted on death. We will have to see the both of those times. So yes, on death, the CLT is not exhausting the band as we have exempted. But CLT in the life definitely has, because CLT is taxable in life. That means we will be able to end up using the value of it. So whatever we have spotted, you have to ask it this way, has that ever exhausted the band? So on death, no, it has not exhausted the band. But definitely in the life, the CLT has exhausted, because CLT is taxable in life. So that will make me to take the value of the CLT into this bracket. And I have. This is how the way this has to go. 232,000 minus 263, that's about 31,000. So what has become taxable? IHT at 40% of that will be 12,400. Taper relief will come in. This will require us to look into the whole distance in between the gift date and death date, and looks to me quite much of a difference. 17, 18, 19, 20, 21, 22, 23 we cannot take because that will be then August 23. The death is on 1st of Jan 23. So 6 years have been completed. 7 years are not. So 6 to 7 will give us the maximum taper relief, 80%. So 12400, the 80% of that is 9920. IHT already paid. This will not be applicable to PET. This step is only applicable to CLT. So 12400 minus 9920, it's about 2480. See, IHT already paid is only valid to CLT, not to PET, because in the case of PET, in the life, it was exempt, no tax was paid. So this person cannot expect to get any relief. PET has become taxable for the first time on death now. Yes, in CLT, in the life, CLT becomes taxable and tax is paid. So today, if it was CLT, he would have got a benefit of IHT already paid. And that's the reason why when I was writing this point into my lecture notes, I specifically have mentioned only in the case of CLTs, this step 5 will come in. There's a bit of a lag onto a screen, I guess. Never it has happened. Usually it does not happen. Might have been getting some less speed at this moment, broadband. It's fine now, I guess. So this step number 5, clearly I have specified that deduct any IHT already paid only in CLTs, will not be applicable to PETs. So that's the end of this. Next, 1st of July 2017, there's going to be a potentially exempt transfer. Sorry, it's CLT. The chargeable amount of that we have to take from our own solution from the lifetime consequences. So the CLT has a value of yeah, 244,500. 244,500. Annual exemption, no, sorry, annual exemption we already have used in the life. NRB is 325,000. When we will look back into last 7 years, when we will look back into last 7 years, check this out, standing it onto this date. Looking back into last 7 years will allow us to land ourselves onto 2010. Rather, we can go back to this timeline itself. So this is the day we are standing it on and looking back into last 7 years. So I will land myself onto 2010. So within 2010, this one comes in, this one comes in. Both are within the range because this will land me onto 2010. That is 12, that is 16. So once again, I will go to ask the question to myself that the two of those transfers that I have spotted has ever exhausted the band. For this, the answer will be same. That CLT has exhausted the band in the life and PET has just come to exhaust the band on death now. So both of the transfers eventually have exhausted the band and I will be able to use the figures of both well within 93,000 for this one, 263,000 for this one. This is how the way we will have to move forward and fill this off. So 93,000 plus 263,000, that has to be 356,000, which means the whole of the NRB has been exhausted. The taxable amount that I have found will be the same as original. IHT at 40%, 244,500. It's 97,800. Taper relief will come into our way. So this is the day we are standing on and have to count down the years involved. 18, 19, 20, 21, 22, 23 we cannot take. So 5 is fully been finalized. 5 to 6 years will give us the taper relief of 60%. The 97,800, the 60% of that has to be 58,680. IHT already paid. Now for this, I will look back and see what was the IHT being paid, and I found that out is 7,500. I will be able to simply put this in. So 97,800 minus 58,680. The figure turns out to be 31620. Okay with that? The process is so repetitive that the moment I'm done with, you've got this impression that you can do that. And all in the steps you have to do it. Moving on to the second last transfer, which is a bet on 1st of December 2019. 1st of December 2019, it's potentially exempt transfer. The chargeable amount is given. It's 21,000. NRB. So we will keep on doing the same thing again and again. Looking back into last 7 years from that point of mark, this is 2019. Can go back to 12. Oh, this might come in, this might not come in. This is 1st December. So if I go back to last 7 years, the date will be 1st of December 2012. So this is not within. These two are within, and both of them have exhausted the band upon the death. And I will go to take the values of these two, which is 263,000 from here and 244,000 from here. It's the process. You work and you keep on doing the same for all the next transfers. It's going to be a huge value. Ultimately, the NRB is fully exhausted, but still, if I have to write it very formally, the value of that is 507,500. Once the taxable amount has been found, the IHT at the 40% turns out to be 8,400. Taper relief will come in or not, we will see. This is 19. So it's going to be 20, 21, 22, 23. We cannot take. So it's going to be 3 to 4 years. 20% taper relief will come in. That takes the total of 8,400 down to where? 1620, I guess. Yeah, 1680. And the answer is turning up to be 6720. Okay with that? The last transfer to end up this question and this side of the top, this leg of the topic is 1st of September 2020. $80,000 has been the value of it. 80,000 has been the value of it. NRB 325,000. Transfers into the last 7 years. For the last time, we will do it. Transfers into the last 7 years. We're standing it on 220. We can go back to 2013. So all of these three transfers are within, and I'm going to take the values of all of these three transfers into this bracket, which will be the same as above, plus the value of this will also be added in. So 507,500 plus 21,000, that's about 528,500. So this will attract no taper relief because the gift was made too close to the death. That taper relief starts from 3 to 4 years. And I don't believe that this will attract any taper relief. Yeah, because that's 20. So it's September 21, September 22, September 23. Does not even complete the 2 years, 3 years. So the taper relief will not be applied. So that's how the way the transfers of the life being taxed in the life first and then upon the death. Whole of that process, the number of times I have been able to revise that. After that, you cannot be confused at how to tax the transfers in the life of the person upon the death, the taper relief, the due dates of payments, the use of annual exemptions, the use of 20%, 25% rate, the use of that 40% rate. Everything has nicely been done. And every corner of every page so far that we have done has not been left aside. As you can see that every area of this page has even been highlighted, underlined, and noted. Pretty much this has been done. This will allow us to take ourselves down to the last leg of this topic, the introductory chapter topic. And the last leg of this topic is about taxing the death transfers. Death estate is called as death transfers because whatever you an individual will be having it on his death will be transferred by the way of will. So in other words, the death estate equals to death transfers. So death estate equals to death transfer. Whatever he or she owns on death is called as death estate. But the same on the other side will be passed on, transferred by a will. So death estate equals to death transfers. Remember when I started the topic, I have divided this topic into two exact portions. This part is over. And finally, we are getting into that part. Those gifts, those will be made upon death via will, we are getting into. And that is going to be the easiest part of the topic. Taxing the death estate is the most easiest, straightforward part of this topic. On the date of death of individual, inheritance tax charge will arise on the value of estate at the date of death. And that value, you should not be forgetting, is called as probate values. Remember, while we have discussed the capital gains tax previously, there this word came to our way, probate value. Then I defined it that the probate value of an asset is in fact the market value of an asset on the day of death, which will be given to us in exams. Debt it include all the assets minus the liabilities, if any. Value of these assets at the date of the death are known as probate value and will be provided to us in exams. You just need to add it up to find the total this way. Just add this off. Now, what sort of items he or she owns? You've been provided with a list of it. You do not need to cram it, because everything in the topic of inheritance tax is chargeable. So you really do not need to be worried what to take, what not to take. Everything to take. It takes properties, freehold, maybe a leasehold. It takes foreign property, because I told you UK domiciled person is subject to UK inheritance tax on worldwide assets. So it might take local foreign properties both. If there has been any mortgage, so you must have to offset it to find the net. Any sort of business is being owned, private house, any investments into stocks and securities, government securities, insurance policy on his name, leasehold property, motor cars, personal chattels. Remember the definition of chattel, tangible, movable properties. So personal chattels will take probably the private house furniture items, table, chair, fixtures, machineries, buildings. Debts due to deceased are in fact the receivables. And these receivables could be the personal receivables, trade receivables, loans receivables, interest receivable, rentals receivable, any type of receivable. We know that is an asset or not. Don't you record receivable to be as an asset in the financial statement? So it will be even an asset for the valuation of, for the purpose of valuing the estate. Receivables will be added. Interest and the rents due to deceased. Deceased, the one who has died. Any sort of balances that he has in his hand or in the bank. Everything you can't see anything is not added into that. Almost anything that one can possibly own on this planet Earth has been taken in, because there are no exemptions for the topic of inheritance. And then minus few of those liabilities, debts due by deceased. Now these are the payables by deceased. It could take personal liabilities to someone he owes, taxes if he owes, rentals if he owes, interest if he owes, some short-term loans if he owes, trade payables if he owes, any liabilities. Taxes payable and funeral expense is a direct cost of death. Upon the death, this cost will only incur once in his life. Definitely a related expense, so one has to deduct. This is how the way the list of total asset minus the list of total liabilities will give us the net answer, which will be called as the value of the estate. An exempt legacy will take what into it? Remember, inter-spouse transfer. So if anything being passed on to wife will be an exempt transfer, and we will come down to subtract the value of it from here. Legacy means gift. Exempt is interspouse. So suppose if the main residence has been transferred to spouse by a will, so initially I will have to add the main residence up there being the part of the list of total. The same I will be coming to subtract that later on. You have to first add it and then subtract it. Has to be both. Add it up there as a part of his wealth and then subtract it next to that because being transferred to spouse. It could be anything. I have just randomly taken a main. It could be shares and securities, could be insurance policy proceeds, could be motor cars, anything. You must first of all have to add this in the list above and come down to subtract, if anything, being transferred out of that to spouse. So it looks only, it's just taking the space of this page But it's nothing, it's just the list that we need to add it. 1 plus 2 plus 2 plus 3 plus 4 plus 5 plus 6. That is what is happening over here. There's nothing to be crammed out of it. Take everything minus liabilities and get the answer, which is called as the value of the state to tax. Key points to remember. Funeral expenses are only allowed when they are reasonable. Reasonable, I mean to say they are normal. A cost that usually incurs on the death of any ordinary person upon his funeral should not be too extensive, should not be too much exceptional. So funeral costs are only allowed when the expenses, those are incurred, they are within the normalities of someone's death. Cost of tombstone is also deductible. The nameplate, in simple words. Cost of administering the death. Sometimes the personal representative, they hire a lawyer who have to come and explain the will. So whatever the consultancy charge, the legal expert will get will not be deductible, because this is the cost being incurred by the personal representatives after his death, not by himself. So cost of administering the estate by the personal representatives, not deductible, as it is a professional fees being carried out after the death. Well, the repayment mortgage is allowed, endowment mortgage is not. Must have to remember, repayment mortgage is allowed as we are allowing it. Endowment mortgage is not allowed. These are the points we will have to keep into our mind while finding the value of estate. And then comes down to the steps to calculate the debt. This topic has been done throughout by following the steps. You cannot neglect the importance of these steps in previous two explanations. If these steps were not there, the life of yours would have been in mess, because you would have a chance of just doing it casually. But these steps have given you a direction, what has to do in the first, followed by the second, followed by third, and then eventually you end up completing the solution. Even when we have started off this thing, we have followed the steps. So they have a lot of benefit in it. So we are once again going to apply the steps, even in taxing the debt transfers. And these steps are, first of all, they tell us, look, you have to deal with the lifetime gifts first. And I've been telling you since the start of the course that the life comes before death. So how can you expect to miss this out on the way to tax the death transfers? You must have to get yourself done with the lifetime gifts first. Tax them first. And we know how to tax them. The whole course, the majority part of the course today, actually been based on taxing the lifetime gifts. Remember, this application was fully on taxing the lifetime gifts. So step one over here is not the step that requires to have any further spending of time. It's there to let you know that you should not bypass taxing the lifetime gifts on the way to tax the death transfers. Should need to do that first. Next one is what? Finalize the value of death estate. Now, finalizing the value of death estate is this thing. And that I already explained how to finalize. Good. Without you can finalize the value, how can you expect to tax it? First thing is to finalize the value of it. So that is step number 2. Finalize it. Once you're done, then calculate the residence limit band. Now, this is a new thing. We have not seen it so far. New thing. Because this residence NRB is available over and above to normal NRB. And residence NRB is only applicable to death estate computations. So you have not seen me making the use of this NRB while taxing the lifetime transfers, as it is applicable only to the death transfers. So what is it? What is the limit of it? When to apply? How to apply? I can come to explain. Well, the step number 4 is in fact the same as old one. Find the remaining NRB by looking back into the transfers in the last 7 years. That's the same typical thing of looking back into last 7 years and see by how far the transfers in the last 7 years have exhausted the NRB and what is the remaining that now I can use. Same as old. And the rate of tax is 40%. We know that the death rate of tax is 40%. So the thing that requires to have a bit of a talk is this step. We can do this. After that, we can start applying that into our questions. Easily can. So what is residence NRB? How will it be applied? When will it be applied? Because it's not applicable every time. It has to satisfy certain conditions. So we are into the discussion of death estate now. And within the banner of this discussion, we are getting down to the talk of residence, NRB, and I can write it very next. Only applies to death estate computations, not lifetime transfers. If it was the case, you would have seen me explaining that to you before in any of the discussion today. It only applies to death estate, which is death transfer. Then there are a few conditions based on to which this will be applied. And I'm going to write when. Two conditions to be fulfilled. The first condition is going to be fulfilled more the time. Death on or after 17th of March 2016. The person has to die after this or on this, which is not going to be a problem because the tax year that you're in automatically comes after to that date. So this condition will automatically be satisfied because your questions in exam will be setting it up a case where the person has died in tax year 22-23, which automatically will satisfy this condition. Getting my point? But this is one of the conditions you have to at least remember being a part of this topic. So I'm writing it. The person has to die on or after 17th of March 2016 to benefit this residence NRB, which is going to be the case. Second condition, which needs to be looked in, owns a residence. How can one get the benefit of residence NRB without owning a residence? It's a big deal owning a residence. Not everyone else owns a residence in his life. Is it right or not? You may own a lot of things, but you may not own a residence. You live in the rented house throughout your life. So owning a residence is not obvious. Some will, some will not. So to apply a residence NRB, person has to own a house in the first place. If the house has not been owned, obviously this topic will be invalid. So owns a residence, then which has been passed on to plus transferred to, the word transfer is good to use, transferred to direct descendants upon death. What does that mean, direct descendants? Children, grandchildren. So owns the house and transferred to direct descendants via will, not to anyone else, but the direct descendants. If this criteria is satisfied, residence NRB is applicable. Don't be worried for this. This will be satisfied automatically. Now, what is the value? That is another thing to answer. When will it be applied? now I can discuss on the other side, how will it be applied? So I can take the same page. When will it be applied? How will it be applied? It takes the lower of two things. Lower of this limit 175,000, just the win NRB is 325,000, residence NRB is 175,000. And the value of residence, whichever is lower, has to be the balance of NRB, residence NRB. So if the value of residence is lower, you will take it. If this limit is lower, you will take it. And yeah, if the residence has got this repayment mortgage on it, we will also need to subtract, because that may not be always there, but if there, then we will have to take it. Minus any mortgage, repayment mortgage. This is all being written over, and I can come to read. See, residence nil band is applicable by taking the lower of two things, 175,000 pound, which is the fixed limit, and the value of house after deducting any repayment mortgage or interest only mortgage. Residence NRB is an additional NRB which is used only in death estate computations. Available, the person has to die after this mark, owned a house which has been gifted to direct descendants. The 6th of April 2017. I can correct it. April 2017. My mistake. 6th of April 2017. Okay with that? So this is residence NRB. Residence NRB does not have got any connection to last 7 years look back and see by how far the portion being used, not being used. Residence in NRB is an addition to normal NRB, and you must have to make sure to apply when these conditions are satisfied. Has to die on or after 6th of April 2017, which is going to be the case. Important thing is that you have to look in, does he own a house? And to whom the house has been passed on to on death? Once the conditions are satisfied, at what value? 175,000 or the value of house, whichever is the lowest. That pretty much ends off the talk, except the questions are only left, which we can keep it now into our next course to finish. This first chapter can still take about 1 hour to solve. See, hardly this page and that page is left. It will be the end of introduction. So probably in the next course, we will be able to spend 1 hour further on before we'll be able to start ourselves with the further aspects. Majority of that chapter we have finished today. Most of the stuff on these pages are in fact the questions. Topic-wise, there's nothing being left that needs to be further talked about. It's all the questions. And that's what I'm telling you can take about 1 hour of the next course to finish. Keeping that old knowledge, you will be able to start understanding the further aspects of inheritance tax. Complex it is. A lot of reliefs are expected to come to your way. A lot of new valuation rules you are expecting to sit under. But all will be understood on the one condition that you keep the whole of the knowledge of the today's course that I have thrown at you. I always say this, and I will keep on, because I know without it, there is no way that you can expect to do well in the life courses and ultimately on the day of exam. Every time we meet up, the course comes to an end so quickly. 4 hours. We do not feel it like how quickly they fly by. 6 sessions today we were on. Time is just running too quick. See at your side if you are with me or not in revising and keeping all of that technical knowledge, because one day we will have to apply all of that knowledge into our exam style questions. So if you have a knowledge, you will be able to apply. If you do not have a knowledge, what you will? See, practicing the question of exam is an application of knowledge. If that one is missing, what can you expect to learn into that exam style question if you're lacking onto a knowledge? Don't you think you have a responsibility towards keeping that old knowledge with you? I had a responsibility to conduct a course on that, delivered. After that, whose responsibility is that to keep that knowledge? Try to be honest to yourself. Am I being further responsible for that? You are responsible for it, keeping all of that knowledge that's been shared to you the past 4 sessions, including today, 5th one, and all that what we are expecting to learn the next 3 months. You have a responsibility to keep that knowledge. I am not responsible for that. Later, when I will come to apply this into exam style questions, you will be responsible to come into that course with that knowledge and watch me practicing questions for you. Else, waste of the time it will going to be. But that stage is far away. Right now, your responsibility is just to at least come into a live session, and once you are done with, take that week coming out to revise it adequately before you show me up into the next course. And all what we have done in the past, capital gains tax, it will be just now your revision. If you do not revise capital gains tax, it will not impact the inheritance tax discussion these days, but it will impact your overall preparation for the later time. Inheritance tax, at least because we have started off, so you expect to come into the next course by fully revising yourself with, so that the next week when we will meet up, we will be able to start off with the same flow that you're in right now, the same momentum that you're in right now, easily. That concludes the course of today. I will see you in the next Sunday course to continue. Have a good weekend. Have a good time. Thank you very much.